disruptor, right? Russia has many levers. The gas supply one is the most significant one for markets. But what I think people tend to forget is that all of these smaller things that are happening around the margins, like the weaponization of refugees coming from Belarus, to the tensions with the Baltic states, Poland, etc. These are also about undermining European unity, and we can see that the new German government has in fact not signed off on Nord Stream 2, even though Merkel's government was very much behind it. So, you know, this ramping up of tensions with Ukraine, you mentioned the phone call today between Biden and Putin, is also a way of saying, of Moscow saying, we have ways of making your lives difficult. We are a force to be reckoned with. We have real leverage in these discussions, and don't forget about us.
Tina, wonderful to catch up with you through much of this year, and thank you for your contribution, not just this morning, but through 2021. Tina Fordham there of Avonhurst. Thank you very much. Matt Miller, as we look at 2021 and what this incoming administration promised to do, which is to bring some order back to the global order, where you're sitting right now, Germany is arguably the country, the government that's compromising efforts with the Chinese Communist Party, one, and the relationship with Russia, two. It keeps coming back to that German relationship on the economic side of things. And I just wonder, Matt, in years and years to come, how we'll reflect on Chancellor Merkel, as she has done very little when it comes to Russia and done very little when it comes to the relationship with the Chinese Communist Party. And when I say done very little, Matt, what I mean by that is that this administration in America would like them to do something very, very different, and she hasn't done it.
Well, the cynical view from Berlin is that that's her MO, doing very little, just making sure things don't get out of control on the downside. I thought it was interesting that Tina pointed out the difference between the incoming government's take on Nord Stream 2 and Merkel's take on Nord Stream 2. So far, we're expecting Scholz, or at least he won the election in a large part due to playing up his similarities to Angela Merkel. He even does the famous Merkel Raute. Can you see that? She does this all the time.
I can see that.
So it'll be interesting to see if his government really does diverge that much, even though he's from the SPD and she was from the CDU. They're very much alike.
Matt, as you point out, we don't know the counterfactual. And doing nothing is doing something sometimes, and maybe that's contributed to some stability we might otherwise not have had. Matt Miller, Kelly Lyons, Jonathan Ferro, your equity market is up 5 on the S&P, advancing a little more than 0.1% from New York City. On radio, on TV, this is Bloomberg.
do we know and what don't we know? Because there's a lot of speculation, a lot of anecdotes circulating right now.
Omicron definitely has the characteristics to create us concern for many reasons. But also we have been preparing for a moment like that for months right now. And I feel comfortable that the playbook will work. So what is the playbook? One, it is to understand more about this virus. The second, of course, will be to protect against infections. And the third is to treat. Let's take it one after the other to understand. I think there are a few things that are not very clear yet with Omicron. One, it is the clinical manifestation of this new variant. Is it creating more severe disease or not? Is it transmitted easier or not? Is it going to younger or older people? All of these are things that, as we see clinical cases coming out and the numbers are getting bigger, that's something that we will know in a few weeks.
Protesters breached the Capitol.
Democracy has prevailed.
A flash mob decided to take on the short.
Giant container ship blocking the Suez Canal.
1,000 new types of crypto coins.
Crackdown on tech in China.
In the billionaire space
The
race.
Delta variant of the COVID virus.
Evergrande is the most heavily indebted developer.
Of the chip shortage.
Withdrawal of U.S. forces from Afghanistan.
We did not get everybody out.
Songs you love.
Rising energy prices.
In Europe, it's a huge crisis.
The Omicron variant has triggered a global rush.
Futures up 4 on the S&P 500, advancing here about 1/10%. On the Nasdaq 100 up 21, advancing a little more than 1/10%. The Russell down 4, -0.2%. Kaylee, 70 record highs, record closes. The most since when? The mid-90s?
1995. We are talking
95.
26 years. We haven't seen records like the ones we've seen this year.
And maybe we get 71 and 72 to close out the year. That's the equity story, a bond market picture. Yields yesterday a bit higher, up 6 or 7 basis points on 10s. Today, this morning, we come back in a couple of basis points to 153.07. On 30s right now, 194.70. Yields in there a couple of basis points too. Bond market a bit of a snooze compared to what we had yesterday. The FX market could get interesting next year. Switch up the board and finish on euro dollar. Euro dollar right now 113.23, -0.2%. Matt, I thought it was really interesting in the last couple of days to hear from the Austrian central bank governor and the governor of the central bank of the Netherlands as well. Two known hawks, I get it, but maybe next year, Matt, the hawks have got the data to back up the argument. You had the likes of the Austrian central bank governor saying, let's get away from negative interest rates next year. The Dutch central bank governor saying maybe early 23 it's time for a hike. And for many people listening to this conversation, Matt, they might be thinking this is ages and ages away, 12 months away. But Matt, we've not had this conversation properly for about 10 years in Europe with the data to back it up. And maybe next year, at the back end at least, the data might back up the argument.
Yeah, well, and they also are going to have cover from the BOE and eventually from the Fed as well. So they could be in a position to raise rates. I'm not sure anybody would have called that as Mario Draghi and Christine Lagarde were switching seats. But as you pointed out a couple of days ago, if you pull up ECFC, you also see economic growth in Europe that people wouldn't have expected previously, certainly not going into the pandemic. So it doesn't seem like negative rates are necessary. And of course, inflation is very scary for Western Europe, especially for the Germans.
Just on the forecast, next year, the ECB's own forecast, growth with a 4 handle, inflation was something north of 2. And to Matt's point on negative interest rates, Kaylee, I think the argument to get away from negative interest rates, maybe the data's been there for quite a while. That's a separate conversation, I guess.
Yeah, for some time. But on the inflation point, John, the ECB is stuck by transitory, something that the Fed has now abandoned. The question is, did they abandon it too late? Let's bring in Mickey Levy, chief economist at Berenberg Capital Markets. He's a longstanding member of the Shadow Open Market Committee. Mickey, when we think about the Fed and its policy pivot, you think that they are already behind the curve. They are at risk of falling further behind the curve because inflation will last longer than previously expected. How much more aggressive does that mean the Fed is going to need to be relative to market expectations?
Okay, so the
Fed has quote unquote pivoted, but it hasn't really done anything. And so when we think about it, with the zero federal funds rate and inflation rising, the negative real funds rate is still extraordinarily accommodative. And so even to get back to neutral, they're going to have to raise the funds rate much more than they currently anticipate is appropriate in their forecast. Their forecast now is to get it up to 1.6% by the end of 2023, which would imply even if they're exactly right and inflation comes down, which seems like a long shot, it implies continued negative real funds rate, which is inconceivable.
Mickey, do you think the appropriate conversation to be having is on the rate hike, the rates mechanism on how much they will hike in 2022, or do we need to be having more of a conversation about starting the runoff of the balance sheet?
Well, I think you're bringing up a very good point. I mean, of course they need to raise rates, and keep in mind, monetary policy is also about money, and the M2, that is bank deposits, are $5.5 trillion higher than they were before the pandemic, waiting to be spent. They're still growing. So the Fed needs to focus on interest rates. But in addition, why in the world are they continuing to buy massive amounts of MBS when the housing market is so strong? It makes no sense at all. So they could certainly unwind that. Treasuries, yes, I'd like to see them eventually unwind it. But on every front, the Fed knows now that it has to do something. And the question is, will it move? And I can virtually guarantee you in the next 3 months, as the Fed considers raising rates in March, the core inflation numbers are going to keep moving up.
How long do you expect this cycle to go, Mickey? How big is the terminal rate going to be?
It's oh boy, on the funds rate, I would say it's eventually going to get to at least 3%, but the risks are to the upside. Once again, there are supply shortages, and some of these are going to linger on. And I would emphasize that particularly in the imbalance between labor supply and labor demand, the Biden administration has every political incentive to spend as much of the infrastructure money as they can pre-midterm election and then the 24 elections. And that's just going to exacerbate the imbalance between supply and demand in labor markets. And so these supply shortages are going to continue. And let's not lose sight of the fact that what's really driving inflation here is excess demand. It's old-fashioned, too much monetary and fiscal stimulus.
In terms of the labor participation rate, how much further do you think that can rise, or have we had a structural change?
Oh, I love your question. I think it's a combination of both. There is some data suggesting that a lot of older people have retired, which suggests labor markets are tighter. I do think the labor force participation rate will rise further. It has definitely further to go. But we've never seen such a large imbalance with labor demand exceeding the supply of labor and new hires by so much. And that's going to take a while to unwind, because keep in mind, as product demand remains strong, businesses need to hire to increase production, not just to meet demand, but to replenish depleted inventory. So that's going to be a very interesting story in 2022. But in addition to the labor supply shortage, you also have workers clearly have the upper hand, as they should, and they're demanding a catch-up to the inflation that's already occurred. And in addition, the higher inflationary expectations are affecting wage-setting behavior. So look for wages to rise in nominal terms, and that's going to continue to fuel this feedback effect on higher inflation.
Mickey, much has been made about this Fed pivot over the last couple of months. So I just want to ask you a very simple, basic question. Is it an objective of this Federal Reserve now to tighten up financial conditions?
my response is a little bit. But what I anticipate here is that this Fed, and as new members come on, it will strike a more dovish tone and be more accepting of higher inflation. That is, I think the Fed's reaction function will be evolving toward more dovish. And so I don't think the Fed has its eyes on raising the funds rate enough to get inflation back to 2%. But I do think it will tamp down and gradually raise rates. So here I must distinguish between what the Fed ought to be doing and what it's most likely to do.
Mickey, wonderful to catch up with you, sir. Mickey Levy there of Berenberg. Thank you very much for everything this year as well. Not just for this morning. Matt, that's got to be the $1 trillion question for next year. It's not about, of course, it's never about what we think the Fed should or shouldn't do. It's about what the Fed will or won't do. And I'm trying to work out whether they will look to tighten financial conditions.
Yeah, well, if they end up tapering down to a complete stop in terms of asset purchases, and as Mickey points out, it may not make a lot of sense to many participants why they're still buying MBS, and then they start to raise rates, the question is, do they reduce their balance sheet? And how does that affect financial conditions? Will they be able to stop inflation without hurting economic growth?
Is it necessary, Kaylee, to tighten financial conditions to get inflation down sufficiently? That's something we'll be talking about through 22 as well.
I think that's a very real question because obviously monetary policy operates with a lag. Any rate hike isn't actually going to show up in some of the data we're getting until months down the line, even after it happens. So it does raise a question because the Fed isn't able to do anything about supply side challenges. They can't fix the supply chain, work out some of those kinks. What they can do is on the demand side of things. And then there's a question, as Matt has raised many times, what does that mean for growth if that's the Fed's only actual option is to start to damp down on growth?
Matt promised something else as well a little bit earlier this hour. Conversation with Dr. Chris Byra, the professor and epidemiologist at the Johns Hopkins Bloomberg School of Public Health. He's going to be joining us in about 5 minutes' time. Take the opportunity to ping in any questions you might have that you want us to ask the doctor in about 4 or 5 minutes' time. I've already had a couple, Matt. If a close contact tests positive and I quarantine for 5 days, then they test positive again, do I have to start a new 5-day quarantine? And Matt, of course, I go back to this issue, and you've raised the question a couple of times over the last few days. They'll have the CDC guidance, one, and then you'll have your own respective guidance from the company you work for as you look to go back into the office.
Yeah, I mean, you've got to use common sense, though, as well, John, right? If a close contact tests positive and you quarantine for 5 days, it doesn't matter whether or not the close contact continues to test positive. It matters whether or not you test positive. But I'll be interested to know if a 5-day period is enough to wait before you can already go out back into the water.
Matt, you're right to bring up the issue of common sense and individual responsibility, but as you know, when it comes to corporations and getting back into the office, it's not about individual responsibility, it's just about the rules. What are the respective rules to come back to work and get back to work again? We can talk about this in a couple of minutes' time. Any questions on Twitter, you know where we are. On the Bloomberg terminal, you know where we are. Futures up 7 on the S&P, advancing a little more than 1/10% from New York City. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. Today will be the second time this month that the leaders of the US and Russia have talked. The White House says that President Biden and Vladimir Putin will discuss a range of topics, but the issue of Ukraine is likely to be prominent. Earlier this month, President Biden told Putin that Russian aggression against Ukraine would be met with unprecedented economic penalties. A new study on the Johnson & Johnson coronavirus vaccine is welcome news for Africa. 2 doses of J&J's shot slashed hospitalizations caused by the Omicron variant in South Africa by up to 85%. The J&J vaccine is increasingly being used across the continent. U.S. Secretary of State Antony Blinken is calling on China to stop arresting Hong Kong journalists. That comes a day after the biggest remaining pro-democracy news organization there, Stand News, shut down following a police raid. Blinken said that journalism is not sedition and that a free pass is a key to Hong Kong's future as a financial hub. And the chairman of Credit Suisse reportedly broke quarantine rules for a second time. According to Reuters, Antonio Orta-Azario attended the Wimbledon tennis finals in London in apparent contravention of UK rules. Earlier, Porto Zario was said to have flown out of Switzerland when he should have, in fact, been in isolation. Credit Suisse isn't commenting. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
What's happening on Wall Street?
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Up front, when your shares are down 20%, it's got to hurt. But talk to us about, well, really what you're seeing. Take us more forward-looking. Are you worried about people exiting pandemic era and going back to the gym, or are we going to work out at home more?
Well, that's actually the advantage that Beachbody has is we have never been a direct competitor with the gym. In fact, what we rely on is our ability to influence the 150 million people in North America specifically who are overweight or obese and haven't made that choice yet. Our job is to influence them with great content and this combination of what we call the total solution: fitness, nutrition, and community, so that they can tap into this incredibly cost-effective solution that is entertaining and engaging right at home so that they get results. That's our job, is to help the new person engage in healthy lifestyles.
Fragile is the European energy complex?
The European energy complex has been incredibly fragile for a number of months now, and it just seems to just keep getting hit with new crises.
Happy holidays from your Bloomberg family.
Container ship blocking the Suez Canal.
Types of crypto coins.
Crackdown on tech in China. In the billionaire space race.
Delta variant.
Chip shortage.
Rising energy prices. The Omicron variant has triggered.
You can get people safely back out in a 5-day period, so long as they wear a mask if they are without symptoms. That is the science. The impact of that is to try and not be in a situation where we essentially have to shut down the entire country. This was not done because of any statement by any CEO of any company.
That is the science. Dr. Fauci there, speaking with ABC from New York City this morning. Good morning. Alongside Katie Lyons and Matt Miller, I'm Jonathan Ferro. Your equity market up 9 on the S&P, advancing 0.2%. We have got a ton of questions on this new isolation guidance from the CDC and some interesting comments from the director of the CDC in the past 24 hours. Let's get straight to it with Dr. Chris Byra, the professor and epidemiologist at the Johns Hopkins Bloomberg School of Public Health. Doctor, let's start here. The CDC has cut isolation from 10 days down to 5. No symptoms, you can go back to work. That should have been seen as a great step forward. Some companies, as you know, particularly on Wall Street, and that's much of our audience this morning, require a negative test to get into the office. The director of the CDC suggested in the last 24 hours that you should not go and look for a negative PCR test because you may well test positive for up to 12 weeks. Doctor, if you have tested positive, you have completed 5 days of isolation, you no longer have symptoms, should companies drop the requirement to have a negative PCR test?
Well, remember, there's another piece to the 5 days, and that is that you need to wear a mask for 5 days after that if you're interacting with other people, and that's to reduce onward transmission. So it's still 10 days, but the difference is it's 5 days of isolation and then 5 days of mask wearing. So don't drop that second part. I think the issue with the testing is that the PCR test can indeed stay positive for longer. And so it's not really informing whether or not you're infectious for others. The antigen tests tend to be more shorter positivity, and they really are looking just for the virus. The antigen is the antigens of the virus. But of course, you can still have a positive antigen test when you are no longer symptomatic. So really the issue is the 5 days after the end of your symptoms and then 5 days of mask wearing after that.
There is a bigger issue, though, sir, as you know, because for so many people, they've been shut out of the workforce over the last 18 months at times for periods up to 2 weeks. Now for them to go into some places, they will need that negative test. And now, as we understand from the CDC director, we still don't understand the relationship between a positive antigen test and transmissibility. Now, doctor, that was news to me in the last 24 hours. Can you shed some light on it?
Yeah, it is true. That is why there's the 5-day masking afterwards, because we think you're much less infectious 5 days after you're asymptomatic, but you still may be shedding some virus and you still may test positive. So the test positivity after you've had COVID really is a challenge. The big change, I think, that's also happened with the new guidance, and this is a part of what's happening, for example, with schools, is the test and stay. We were locking people down and having them stay 10 days out of work and out of school for an exposure, not for having COVID. And that is really a change. There needs to be much more testing for people who've had an exposure. And for kids, for example, they can stay in the class. People can stay at work if they've had not COVID, but a potential exposure to COVID with a negative test. And in those cases, the testing will be more meaningful.
Well, Dr. Byra, I'm glad you brought up schools, because obviously when we're talking about barriers of people returning to work, it's also for caretakers who, if their child is home from school, they have to consider that. But at the same time, when we look at pediatric cases and hospitalizations, those are climbing quite substantially. And obviously children of a certain age have gotten a lower dose of the vaccine to begin with. With Omicron now the threat, do we need to be rethinking either the dosage or boosting children?
Well, we are recommending boosters for everyone over age 16. The trials are underway to look at boosting in younger kids. Both Omicron and Delta are part of what is happening with this surge. It varies across the country and across the world, but it's looking like 60-40 Omicron Delta, so you know we're dealing with both variants at this point, and both, of course, can infect children. It does appear that Omicron, because of its high infectivity, is infecting more kids. Hospitalizations are up, but at a slower rate than cases. Cases, as you all know, are exploding. Hospitalization is only up about 11% across the U.S.
But how much of that is the fact that hospitalizations and deaths lag the case numbers, and that's been the case for the entire pandemic?
Yes, that is certainly a part of it. But it's also the case that, while hospitalizations are slowly increasing, case numbers are exploding. We had the largest number ever yesterday, over 400,000, and we're still not doing enough testing. So we know that that's still an underestimate. We also know that there's always a lag between hospitalizations and deaths. We don't expect to see really that peak until come mid-January. But again, so far anyway, the death rates do look lower. And the good news there is that they look lower also in countries that have been dealing with Omicron longer, like South Africa.
I noticed that you're the Desmond Tutu Professor of Public Health and Human Rights. So I wonder, what is your take on vaccine mandates, considering the U.S. has a pretty bad history with forcing medical treatment on a lot of groups?
Well, first of all, let me just say that, of course, we lost Desmond Tutu on the 26th, and he was just an incredible champion, both of public health and of human rights. He led the effort, for example, against AIDS denialism in South Africa and played a huge role there. I think the argument that he would have made is not so much about mandates and rights, but more about access and rights. And so he was really a champion for ending what people, the activists, have called vaccine apartheid, the very, very low rates of vaccine access in Africa across the continent. But that said, mandates have been constitutional in the United States for 116 years. Mandates work. There's good evidence that they work. It often takes the onus away from the individual, moves it more onto the society, employers, the government. That can have a big impact on people. And we've been under a vaccine mandate at Hopkins, where I work, for many, many months now, and we now have a booster mandate. The university is mandating boosters for people who want to be on campus, and I think that's totally appropriate.
Doctor, it's good to catch up, to get your opinion on things. Dr. Chris Murray there of the Johns Hopkins Bloomberg School of Public Health. Matt, we asked the question a couple of months ago, how quickly would it be, how long would you need before you needed a booster to become fully vaccinated? And we're basically already there, aren't we? And Matt, you do wonder, is it another 4 to 6 months before you'll be required to get, say, another shot? We still don't really know, do we?
No, I absolutely not. I think all of the healthcare professionals that we talk to say we just really need more data. But look, I get a flu shot every year. I continually get flu shots. I am never fully vaccinated against influenza, and I plan to continue that.
But there's a difference, Matt.
Why wouldn't I?
Matt, there is a difference. You get a flu shot, I get a flu shot, and typically I don't care whether Kaylee got a flu shot or not. That seems to be the difference this time around. With Katie Lyons, Matt Miller, and Jonathan Ferro.
I would prefer she did.
On radio and on TV.
Noted, Matt. Thanks.
This is Bloomberg.
How all that chocolate makes it to the supermarkets in time for Christmas? I'm James Walcock, and I got really curious how chocolate makes its way to the supermarkets every Christmas. So I came here to Nestle's distribution centre to find out how it works. Almost 120 lorries come here every day, and they drop off coffee, chocolate, Kit Kats, toffee crisp, you name it. If it's made by Nestle, it will come through here and it will get sorted by machines who will then load it onto a monorail that runs right up and down the facility. Automated cranes, like this one coming in behind me now, then load all of the chocolate, storage, all of Nestle's goods into this big warehouse. It can hold up to 100,000 crates. And then after it's been sorted and stored, sometimes for months, it will then end up over here, where then lorries will then take it out to supermarkets up and down the country. You can see the entire process is done without people. Goods can come and leave, sometimes without ever touching human hands. It's one of the largest automated centres in the UK, and it opened during COVID. So this Xmas is its first big test, and so far, it looks like things are going well.
How will pricing have to adjust or not as a result of your greener ambitions?
We ran a big survey around 32 countries. More than 30,000 people took part. And as you say, there was a big gap in between people that were worried about climate and people that were taking action.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Protesters breached the Capitol.
Democracy has prevailed.
A flash mob decided to take on the short.
Giant container ship blocking the Suez Canal.
1,000 new types of crypto coins.
Crackdown on tech in China.
In the billionaire space race.
The Delta variant of the COVID virus.
Evergrande is the most heavily indebted developer.
Of the chip shortage.
Withdrawal of U.S. forces from Afghanistan.
We did not get everybody out.
Songs, your love.
Rising energy prices.
In Europe, it's a huge crisis.
The Omicron variant has triggered a global rush.
We're going to have a very volatile year ahead of us.
People have done what they do when there's easy money. What we haven't seen is how they react when that easy money gets pulled back.
The buy the dip half-life, as I like to call it, has been shrinking.
You want companies that aren't predicated on free money.
The story ahead has got to be earnings.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Is it the beginning of the end for easy money? From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Matt Miller and Katie Lyons. I'm Jonathan Farrow. Your equity market up 9 on the S&P, advancing 0.2%. It's just been all-time high, Kaylee, after all-time high.
Yeah, they've come 1 in every 3 trading days roughly this year, John. 70 in total, the most since 1995. We could very well see another one today, possibly even tomorrow. It has really been quite remarkable. This equity market up the better part of 30%, far and away above where we thought we would be coming into this year.
And we keep going back to the same question, Matt Miller. Is it the beginning of the end of easy money? Or is it just a story of easy money getting less easier but still remaining easy?
Yeah, well, we don't know the answer to that, right? We're looking forward to seeing what the Fed does. March, according to Governor Waller, is going to be a live meeting, but most of the guests that we've had on don't expect a rate increase in March. The question is also of sequencing. How are we going to see the balance sheet unwound if they really feel like doing that at all? So these are all things that affect financial conditions, and we'll be following the FCON screen on the terminal very closely.
You sound extremely excited about the new year, Matt, just like me, as we look to close out 21.
You know what? I was so pumped when I came in on Monday. We'd had 3 days of a big rally. We rallied hard on Monday, too. I know it was light volume, but I just felt like there was a lot going on still. Even yesterday with the Richmond Fed manufacturing survey, I was genuinely excited. That enthusiasm is starting to fade a little bit because the market feels like someone let the air out of it.
Matt, when anyone says they're excited about the Richmond Fed, I do have to ask the question, how excited you actually are. We'll talk about that in a moment. Well, up 7 on the S&P, advancing a little more than 1/10%. Your NASDAQ 100 up 35, call it 34, up 0.2%. Yields are in a couple of basis points to 152.89. Katie, you gave us the streak on crude a little bit earlier. We're snapping it. We're down 0.6%.
We're up 6 days in a row prior to today. Still, though, we're looking at a 76 handle. So dancing around the highest level in about a month. The supply picture is looking a little bit better. And then demand, too. How much is the Omicron variant really a threat, or have we reevaluated that? We'll also be taking a look at the equity market and the path forward for volatility. The VIX is a lot lower than it was earlier this month. The question is, does that normalization continue into the new year? Amy Wu-Silverman, equity derivative strategist at RBC, will be joining us, and we'll continue that equity conversation with Steve Whiting over at Citi Global Wealth. Then we'll get into oil specifically, John, and whether or not those prices will be enticing shale players to drill anymore, or do they keep that discipline really focused on returning money to shareholders? Janine Wei, senior U.S. integrated oil and E&P analyst over at Barclays, will be joining us. And then we'll come back to the pandemic, because it seems like we have never-ending questions as the messaging and the guidance is really quite confusing, John. Deborah Fuller of the University of Washington School of Medicine will be joining us later on.
The confusion from the CDC. I mean, Kelly, your thoughts on that? Have you any clearer on what you need to do after you've tested positive for COVID to get back into work?
No, absolutely not. And I think messaging has been a continual problem throughout this entire pandemic, frankly. First, it was on vaccines and who needed to get boosters or not. Even prior to that, it was the efficacy of wearing masks. The messaging around this is also one of the policy failures that we have to talk about as we think about what has gone wrong during this pandemic.
Matt, as you know, a big part of this audience, the financial community, the banks that they work for require a negative test to come into the office. And Matt, we've just heard from the CDC director saying, don't go and get a PCR test after you've tested positive, because you could test positive for up to 12 weeks.
Well, you know, to be fair, she can't control the science, right? If those tests continue to give you positive results because they're testing for antibodies in your system and not for viral shedding, then that's simply the case. As we just heard from Dr. Byrer, you should instead get an antigen test, which tells you how much of the virus you still have in you. Do they require the banks a PCR test? Is it not okay just to get a lateral flow test?
Some companies do, and Matt, on the rapid
they're going to have
test,
to change that.
On the rapid test, Matt, what they admitted in the last 24 hours is they don't understand still the relationship between a positive test and transmissibility. That's a difficult one, Matt, because if we don't understand the background to that, you say they don't understand the science, Matt, they can't control the science. Well, they don't understand the facts yet either. That's maybe not their fault, Matt, but we don't have the facts for that. So if you don't know, then it's all about risk management. And I go back to another thing, Matt, because the previous administration were criticized for this as well. Is it about the science or behavioral psychology? Because the CDC director also said the following, Matt. It also had a lot to do with what we thought people would be able to tolerate. Now, Matt, is that about the science or about behavioral psychology?
I think they're sprinkling in a little bit of both there, and this is the common complaint that you get. It's not backed by science. I get these IBs from viewers all day long when we're talking about the CDC, when we're talking about the regulations or the suggestions that come from these government organizations, but they're trying to do the best they can, I hope. You know, I'm putting my faith in them for that. As Kaylee points out, you know, a lot of these views have changed. The mask wearing, I think, is one of the most interesting. For so long, we were told, well, they didn't know whether or not masks reduce transmission. Then they said you wear masks to protect others from getting the virus from you. Now they're telling you if you wear a FFP2 mask correctly, then you can prevent yourself from getting the virus from others. The messaging has been all over the place, but that's because we continue to find new results.
And continues to be the case going into 2022. Your 10-year this morning, just to get back to markets quickly, down 2 basis points at 153. One of the mysteries of the bond market through 2021. Inflation all the way up here, your 10-year yield all the way down here. Why? Colin Martin joins us now, fixed income strategist at the Schwab Center for Financial Research. Colin, let's start there. Why?
Well, it seems like the market's telling us two things. First, it's telling us that it's not too concerned about the recent surge in inflation, or at least it's not concerned that it's going to be very persistent, meaning it's at these high levels. It might not go back to the levels we saw pre-pandemic, but the markets aren't expecting persistently high, 5, 6, 7% inflation rates. But it's also telling us that we might just be back to this low growth, sort of high inflation era that we were in, pre-pandemic. Inflation is likely to be higher, but it's telling us that the growth outlook might not be as strong. If you go back to the last rate hike cycle, the markets told the Fed and told Powell that they tightened too much when they barely got above 2%. And when we look at long-term euro dollars, Fed funds markets, really just what the long-term Treasury yields are telling us is that the Fed really can't hike that much. And it's telling us that it might not even be able to get to 2%. So that's part of the reason why we're seeing yields so stubbornly low right now.
Do you think the curve will also be stubbornly flatter in the year ahead, Colin?
We do. We think we can see bouts of steepening here and there, depending on the day, depending on the week, depending on what the headlines are. But the trend is likely to be a flatter yield curve. That's consistent with what we see during most rate hike cycles. But what we're seeing today is that we're already at flat levels that are seen halfway through a rate hike cycle or towards the end of a rate hike cycle. And in certain parts of the curve, like 5s, 10s, 530s, areas like that, we're at levels that we saw last time again once the Fed hit its peak Fed funds rate, and this time they haven't even hiked yet.
What is the terminal rate you're expecting now? We just heard from Marty Levy upwards of Mickey Levy, upwards of 3%.
That's a bit more optimistic than our outlook. We're likely still in the 2 to 2.5% range right now. The Fed's still pointing to 2.5% based on their median dots projection. We'd probably take the under for that right now, just based on what we saw during the last rate hike cycle. But when you talk about the terminal rate, that's what's preventing long-term yields from rising too much, and it's what's holding down our outlook for long-term yields in 2022. We think as we look into next year, the 10-year Treasury today are at around 1.5%. We think you can get to 1.75, maybe 2% on the high end next year. But until we see expectations for that terminal rate move significantly higher, it's going to be difficult to get above that 2% level anytime soon.
Colin, what's the number one thing going into next year that you have the lowest amount of conviction on?
The lowest amount of conviction on? That the Fed will act aggressively in shrinking its balance sheet. They probably should move somewhat aggressively, and by that I mean maybe just a little bit faster than what they did last time. But they seem to be slow playing this right now. They're clearly laying the breadcrumbs where Powell acknowledged that they discussed it at the last meeting, and Waller's talking about a quicker reduction. We've heard similar comments from Bullard. But the way they've approached policy over the past year plus tells us that they're probably going to take a little bit of a slower pace there. But if they do really want to see yields move a little bit higher and get a steeper yield curve, they have those tools. They hold so many treasuries that they could offer to other investors.
Yeah.
But until we hear otherwise from Fed officials, they'll probably take a relatively patient approach.
Colin, brilliant work this year, buddy. Send our best to the team. Thank you very much. Colin Martin of the Schwab Center for Financial Research. Just a hint there of something John Riding said of Green Capital earlier this week, Kaylee. Don't wait just to roll things off.
Yeah.
Don't wait to cease reinvestment of securities. Maybe think about selling them.
Yeah, and we've heard consistently from John Riding, just there and others, there's a difference between what everybody thinks the Fed should do, what would be the reasonable policy response that would make sense, and what they're actually going to do, John. There's a big gap there.
There always is. Matt, there's an industry, isn't there, in complaining about the Federal Reserve? This one's really ramped up for about 10 years. What is it, Matt?
Fed Up by Danielle DiMartino.
Oh, of course.
I love the title.
I like that title too. Yields lower 2 basis points on 10s, 153.24. I just thought you were fed up, Matt. I could sense that as the week grows a little bit older, that Matt's getting a little bit more upset about the post-Christmas coverage going into the new year. Futures up 8, advancing 0.2% on radio and on TV. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. Today will be the second time this month that the leaders of the US and Russia have talked. The White House says that President Biden and Vladimir Putin will discuss a range of topics, but the issue of Ukraine is likely to be prominent. Earlier this month, President Biden told Putin that Russian aggression against Ukraine would be met with unprecedented economic penalties. A new study on the Johnson & Johnson coronavirus vaccine is welcome news for Africa. 2 doses of J&J's shot slashed hospitalizations caused by the Omicron variant in South Africa by up to 85%. The J&J vaccine is increasingly being used across the continent. U.S. Secretary of State Antony Blinken is calling on China to stop arresting Hong Kong journalists. That comes a day after the biggest remaining pro-democracy news organization there, Stand News, shut down following a police raid. Blinken said that journalism is not sedition and that a free press is a key to Hong Kong's future as a financial hub. And the chairman of Credit Suisse reportedly broke quarantine rules a second time, according to Reuters. Antonio Orta-Ozario attended the Wimbledon tennis finals in London in apparent contravention of UK rules. Earlier, Orta-Ozario was said to have flown out of Switzerland when he should have been in isolation. Credit Suisse isn't commenting. Global News 24 hours a day, on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
When you talk about the commercial viability, the idea that these companies can actually make money off of this here, does this become, I guess, something that's niche in the sense that you have to pay several $100,000s to do it? Or does it come back down to a level where just regular folks like you and me will somehow find a way to be able to take a trip up, and this can be a business model that will be sustained?
I think it's important to note that space tourism is a small segment of the overall global space economy. Space tourism accounts for $1 billion of a global $350 billion global space economy.
What's the rest of it?
$260 billion of that is satellites, manufacturing them, launching them. And these satellites we use in our everyday lives, whether that's to listen to the radio, to watch Bloomberg on our satellite television, or to navigate us to our destination via GPS. And I hope in the near-term future, we will add getting our internet from space.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
inflation, supply chain issues, and the fuel price crises are clearly the main drivers of risk in markets. And the point that I want to make there is that there are also huge problems for incumbent governments and are going to cause a range of attempted policy responses and maybe even poor policy responses.
Looking ahead to next year, to 2022, with Tina Fordham there, the head of global policy strategy at Avonhurst. From New York City with Katie Lyons and Matt Miller, I'm Jonathan Ferro. Futures up 9, advancing 0.2%. Yields in 2 basis points lower to 153. Euro dollar, a weaker euro on that currency pair, negative 0.25% at 113.20. As far as the diary is concerned down in Washington, D.C., the time 3:30 Eastern time, according to an official of this administration. That is when a call will take place between the president of Russia and the president of the United States. Joining us now is Greg Valliere, the chief U.S. policy strategist at AGF Investments. Greg, let's start there. Your outlook for geopolitics, this tussle, this tension between the United States and Russia, and the United States and the Chinese Communist Party.
Yeah, John, good morning. I do think this is a big wild card for next year. I think for the time being, Vladimir Putin has to worry about a guerrilla war. If he invades eastern Ukraine, I think the Ukrainian army can't beat him, obviously. But you could have in the hills a guerrilla movement. There's a lot of buzz right now about how ordinary Ukrainians would fight. So does Vladimir Putin really want to have that happen to him and his job approval rating back in Moscow, back in Russia? I think it'll give him pause. The other big story, John, obviously, is China. Post-Olympics, by the end of this winter, I think China will sound even more belligerent on Taiwan. I think the U.S.-China relations will stay very rocky.
Greg, talk to me about that, how one may impact the other. We've seen President Putin make incursions elsewhere, particularly about 7 years ago with Crimea. Not exactly a big red flag to the Chinese to say not to do the same. And Greg, I do wonder, you see the two stories linked in some way?
Yeah, in some way, and I'd add, John, Afghanistan. The way we exited, it was so inept, it was so dysfunctional that I think Afghanistan showed not only our allies, but our adversaries that our foreign policy has some real flaws.
Is that going to be a problem for this administration in the midterms?
Well, you know, the midterms is quite a smorgasbord of issues coming up. You've got terrible messaging, as you guys have been talking about this morning on COVID. You've got clearly inflation being a problem for a while. So I really think that Joe Biden needs a victory. He needs to get something. And I think that the White House will be willing to take just about anything from Joe Manchin. And as you guys know, I said most of the fall, I didn't think we'd get a deal. Now I'm beginning to think there will be something in the spring that the White House might be able to call a victory.
But I mean, they'll take anything from Joe Manchin, then you get Kirsten Sinema, who wants something different. Even if they take what Joe Manchin wants, are they going to face resistance from someone else?
Good point, Matt. I think when push comes to shove, Kirsten Sinema will go along. I think that Manchin is still the biggest wild card, but I think even he would be willing to take scaled back provisions, scale back child tax credit, scale back on a lot of issues. Maybe instead of, $2 trillion, it goes down to $900 billion. But I do think there's a deal there. And again, I think the White House and even the progressives will take anything they can get.
Greg, taking domestic policy and foreign policy together and assessing the Biden administration about 1 year in, how much success have the administration had at fulfilling some of its campaign promises to build back better and to bring America back to the global stage?
Well, we got a big infrastructure bill, Kaylee. That was a big deal. But otherwise, it's been a very mixed picture, very confusing. I do think that they'll look for people to blame if the inflation problem persists. They'll have antitrust officials look at price gouging, things like that, anything to find blame, because they're looking at a really bad loss in November in the House. The Republicans only need a net gain of 5 seats. I think it's likely that the Republicans will have a net gain of 20 or 25. That means in the second 2 years of Biden's presidency, I don't think we'll get much done at all.
Well, and speaking of the president, and this relates to the midterms as well, his approval ratings have been stuck in a very, very low range. Inflation, as you mentioned, part of the problem that's dogging his administration. Can you see anything being accomplished that actually is able to lift those ratings?
Well, again, that's why I think we can still get a deal. I do think that while there'll be real choppy news in the first half, especially with inflation, I think as we get into the second half, the economy and the markets may look a little more steady, but he needs this quickly. And if he doesn't get it quickly, not only is the House very likely to fall, there's also a decent chance the Senate could fall as well.
Greg, it feels early to ask this question, but I think it's an important one, and many people are asking it. What do you think will inform the president's decision to run for a second term? And do you think after the midterms is the right time to make that call?
Yeah, it's a subject of great speculation, John, here in Washington, and he has to say he's running. He did last week. If he says I'm not sure, he's a lame duck instantly. So he has to say that he's running. And he said last week as long as his health is good. But I have to tell you, you talk to people inside the Beltway in both parties, and there's widespread opinion that he will not run for a second term. The problem for the Democrats is that they don't have an obvious successor.
Greg Valliere, we appreciate your insights, sir, for everything this year too. Greg, been a good friend of this program. Thank you, buddy. Greg Valliere there of AGF Investments. Matt, I said a couple of days ago, some good news for the Democrats. It exists. The good news is the midterms aren't today. They're next year. Because if they were today, that wouldn't be pretty.
It's a very good point. They have until the summer, and you can bet they're hoping that this pandemic turns to an endemic, but maybe even more importantly, that inflation really is transitory.
Yep.
It will be very helpful to the Biden administration if prices stop accelerating at such a pace.
To that point, can you imagine, Kelly, a situation by the time we get to next summer, inflation's fading, maybe they've passed something big? I have no idea. Maybe Senator Manchin gets on board, Senator Sinema as well, and next summer looks very different to what we're experiencing right now.
It's entirely possible, John, but then you have to consider just historical precedent. And usually the midterms do not go the way of the incumbent party. That's just how it traditionally goes. And I think the Democrats have quite a challenge, even if they are able to pass Build Back Better in some form of getting, retaining their majority, given how narrow it already is. It's going to be a very interesting question to see if anything can really move that needle.
And for anyone out there wondering if it's too early to ask the question whether this president will run for a second term, they were asking this question in the election campaign before he even became the president.
Yeah.
Would he run for a second term? So here we are. I imagine those questions pick up big time through 22. From New York City this morning, looking to close out 2021 with Katie Lyons and Matt Miller. Just a couple more sessions to go. Futures, positive 9 on the S&P. We're up 0.2%. Yields are lower by 2 basis points after pushing higher by 6 or 7 yesterday. Your 10-year 153.24. Euro dollar, negative 0.2% on that currency pair. A weaker euro at 113.26. On radio, on TV, this is Bloomberg Surveillance.
from the worker perspective, a recent headline, you got Kellogg's Cereal Union says the latest agreement that they had was rejected. Deere had to finally make a union contract. How concerned are you about the longshoreman contract and union negotiations right now?
Well, we're some time away from that. The contract expires on the 30th of June next year, and both sides have told me that they'll sit down to the table and begin negotiating in May. These are always important discussions, and usually when the spotlight is on our industry. But there'll be some issues around wages. The industry is making a lot of money. The longshore folks would like to see that. Now, I don't speak for either side, but training and development of the workforce will also be key as robotics and automation are front and center. The workers cannot be left behind.
Yeah, but to that point, I mean, do you feel like the balance, though, has shifted? I mean, for so long, workers had a lot less negotiating power. Do you feel like the pendulum's shifting?
The International Longshore and Warehouse Union, which does work across 29 West Coast ports, is very strong and a democratic organization.
Protesters breached the Capitol.
Democracy has prevailed.
A flash mob decided to take on the shore.
Giant container ship blocking the Suez Canal.
1,000 new types of crypto coins.
Crackdown on tech in China.
And
the billionaire space race.
The Delta variant of the COVID virus.
Evergrande is the most heavily indebted developer.
Of the chip shortage.
Withdrawal of U.S. forces from Afghanistan.
We did not get everybody out.
Sound the alarm.
Rising energy prices.
In Europe, it's a huge crisis.
The Omicron variant has triggered a global rush.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
2 more trading days to go from New York City this morning. Good morning. Here's the price action live on TV and radio. We're positive 9 on the S&P, up 0.2%, advancing on the Nasdaq 100 by 0.25% on the Russell, up by just a half a point. Pretty much dead flat there. Katie pointing out we've had 70 all-time highs, closing record highs on the S&P 500 this year. The greatest amount of closing records since the year 1995. Can we get 71, 72 to close out 2021? Switch on the board and get to the bond market. I'll go through some forecasts for you. 260 on a 10-year, year-end next year, the call from SocGen. 150 on the 10-year, year-end next year, the call from HSBC. That's the spread between the low and the high that I've seen so far, at least. The big groupings are bunching around 2%. Right now, 153.24. The why? Well, let's get into the why. We spoke to Colin Martin of Schwab. He pointed out that he thinks there's some doubts here of the Fed's ability to get back to 2% on the Fed funds rate. I've got some questions as we start to throw around terms like tighter monetary policy, the end of easy money. If the Federal Reserve hiked 1 full percentage point, they're still easy. They're still accommodative with inflation close to 7%. When do they actually start to tighten financial conditions? That's a conversation we continue to have on this program. I'll finish on this for you, Kaylee. In the FX market, euro-dollar switch on the board looks a little something like this. Euro-dollar negative 0.2% to 113.29. A couple of hawks out there in the last couple of days, talking up the prospect of a rate hike from the ECB, maybe the end of next year, maybe early 23. The ECB President Christine Lagarde wants nothing to do with the 2022 conversation. You wonder if it's avoidable with a data set to come in pretty decently, Kaylee, for the Eurozone next year.
Yeah, it's an excellent question. That data has been coming in hot for some time already as it is, John. So what is that? What case does that make? And of course, we're talking about whether or not monetary policy is going to get tighter, what that actually means. But what will the read-through be to the equity markets? Amy Wu Silverman, equity derivative strategist at RBC Capital Markets, joining us now. Amy, we focus a lot on how easier money means kind of subdued volatility. In theory, that would mean that once you start to see that being pulled back, volatility will remain elevated. You see it instead normalizing, though, in 2022 even further. Why?
Yeah, you know, it's interesting. I'll just give you one data point. In 2008, we hit essentially the same volatility max levels that we did during the pandemic. It took us 4 more years to normalize back to pre-2008 levels. We've already done it, Kaylee. Between 2020 and 2021, there's been a 25 realized volatility point drop in the averages we're seeing as this year closes. And I think that continues because even though we get pockets of realized volatility, the volatility market has essentially already gotten used to this new normal.
And also, we've seen this year, and this comes back to easy money, buying the dip has worked every single time. It has been the consistent behavior. Do you think that will change in the year ahead? I
actually think it will not. I think we are going to get another GameStop, AMC meme/YOLO situation again this year. Unfortunately, I cannot predict what stock will be the target, but, we track that very closely through skew inversions, looking at these call demand levels compared to put demand levels. And I think it's going to be very correlated to what we see happen with the cryptocurrency path this coming year, especially with regulatory, items coming down the line.
What do you look back at to help you predict 2022? I mean, do you compare the COVID pandemic to the global financial crisis to the internet bubble burst? How do you gather the experience necessary to look forward?
Yeah, that's exactly right. That's a big part of it. We look at seasonality changes sliced both through realized implied volatility levels, back essentially as far as we can go, even to 1987. And one of the really interesting facts is during the pandemic, we hit volatility levels that actually surpassed 1987, as well as the other crises you mentioned. And so the fact that we've come down to pre-pandemic levels within the last 2 years compared to all the other situations where it took 4 to 5 years to normalize just kind of tells you how resilient the market has been overall and how that has bled down into the volatility markets as well.
In terms of volatility, we still have a lot of elevated indicators. For example, if I look at price earnings ratios, we're still at 26. I think historically the level is around 17 to 20. What do you see? How long do you see this market taking to get really back to normal from the pandemic?
I think it happens next year. One thing I would point to is the way we're going to see disparity, particularly in options, is going to be within the different subsectors and factors. So, as interest rates rise, you're going to start to see that distinction between value, between growth. And so I think you'll see pockets of volatility difference between an IWM or a Qs or a SPY. But that overall level, I think when we're sitting here at the end of 2022, we'll probably be at a 12 or 11 handle in terms of realized volatility, and certainly a sub 20 level in the VIX.
Amy, I want to come back to the retail investor because you mentioned GameStop, and I cannot believe that was a phenomenon that began almost an entire year ago. In some ways, it feels like it was just last month. But when I think about the factors that were driving that activity on the part of retail traders, we had massive government stimulus. They had more money in their pockets, and you obviously had ample liquidity provided by the Federal Reserve. If those two things are normalizing, why would retail activity not be more subdued as a result?
I think that's a great question. And I think part of the answer is it probably will. However, look, the person who is on Robinhood and trading GameStop options is really the same person who's also owning Bitcoin and Ethereum and, that whole suite of things. And so, look, if we go into 2022 and we get a massive rise in cryptocurrencies, you're going to see that wealth effect, I think, spread over into the options again. We know that this investor is both savvy in both pockets. And the other thing I think is interesting is, I don't know if you recall back in November when we kind of had that volatility freak out, with VIX kind of really ramping up plus 60% that month. You actually saw the retail cohort owning puts, which is something that they hadn't done through the entire pandemic, but they're clearly capable of doing. So it may not even be that they're trying to own upside through calls. If they see this market going down, you might actually see that put option volume really spreading as well.
Let the record show retail traders can be bearish on some occasions. Amy, you mentioned a tie too with the cryptocurrencies, and we talk a lot about equity volatility. There was a narrative out there that crypto volatility was going to start to become, much more subdued as you have institutional adoption, as you have the introduction of a kind of formal mechanisms like a crypto ETF. We did get those things this year, and yet you're seeing just as much volatility. Do you have any reason to expect that will change?
I think, look, in kind of the overarching, decade, 10,000 foot level, sure, that institutional adoption, all those themes you mentioned will eventually cause volatility to kind of normalize. I don't think we're anywhere close to that. I think a large part will be regulation. The second half of next year will also be a big catalyst for the Ethereum network when they go from proof of work to proof of stake. And, all these things are still really in their infancy. So I think that cryptocurrency continues to behave like a risk asset. And, when you just kind of say top 10 biggest drawdowns in crypto, what did S&P do? The correlation levels over kind of a 1 to 2 year time frame is still only 30%. I think that has a long way to go in terms of how that behaves as regulation comes down the line, Haley.
Amy, as we look back and assess the year 2021, it was about 12 months ago when we started the GameStop mania, the meme mania, people talking about the apes, etc., etc. Amy, what frustrated Tom and I at the time is how many people looked down their nose at some of these investors. This so-called new entrant into financial markets. Amy, what's your lesson? Because you talked about, just briefly then, the sophistication of some of these individuals in this market. And I think, Amy, that's still overlooked 12 months later. What have you learned about that?
It's been an absolutely fascinating ride for me as someone, look, I've been in derivatives for 20 years. And for most of that time, it was just this niche thing. No one ever knew, what I did. Mom and dad thinks I'm a stockbroker, that kind of thing. And then, you look at Reddit and they're talking about gamma squeezes, which is something that, you can't really know unless you've had kind of a more savvy introduction into the industry. These investors knew that they were causing these momentum, dealer-based over-hedging in the market, and that was causing a lot of the action that you're seeing. And that's why we actually, separately track now the activity of skew inversions in something like a Tesla or GameStop or AMC. And we split that out from the more, I guess, blue chip parts of the market, because we know this activity is something that can continue to be a phenomenon.
Amy, thank you. Thank you for everything this year. Amy Wu Silverman, just the wonderful Amy Wu Silverman of RBC. And Matt, I think we've got to appreciate, of course, on some of these forums, the composition of the investor base is not all the same. It's not just retail, there's some institutional investors in there too. But Matt, I think it's fair to say we've got to get away from this dumb money story of decades ago. The retail investor of today is exceptionally sharp in many, many cases compared to what people might have thought they were 20, 30 years ago.
Yeah, absolutely, and changed the narrative. And this isn't the case of something that's burnt out already. We were just talking the other day about GameStop. It's still up 700% from the beginning of the year. I'm still not sure what people are going to buy from GameStop, because I download all my video games online directly to the console. But it'll be interesting to see. And I think Amy's point to the sophistication of the investors on a forum like Wall Street Bets is really key. A lot of them know what they're talking about, and if you spend enough time there, you pick some of it up.
They understood what was driving institutional trading, and Katie, it's funny that we end the year and it's institutions working out what's driving their thoughts, driving their trading strategy.
Yeah, absolutely. I mean, retail investors have proven to be a collective force in this market, because a lot of their power came from that it was pack mentality, that you had all of these people going in at once on these trades, and therefore, to some extent, they couldn't lose because everything was going in one direction.
I've never liked that phrase, the dumb money, the smart money. The smart money in the bond market, ask them why we're at 150 on 10s. And everyone's like, well, we shouldn't be down. Well, we are at 153 on 10s. Yields are lower by a couple of basis points this morning. Good morning to you all. Katie Lyons, Matt Miller, Jonathan Ferro. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. President Biden and Russian leader Vladimir Putin plan to talk by phone today on what the White House calls a range of topics. U.S. concern about Russia's military buildup on Ukraine's border is likely to be high on that list. In their call several weeks ago, the U.S. president warned that Russian aggression would be met with unprecedented economic actions. Another record number of daily coronavirus cases worldwide. More than 1.7 million people worldwide were reported to have COVID on Wednesday. That's the most ever, and the third day in a row with more than 1 million infections. The higher transmissibility of the Omicron variant is expected to drive records in the days to come as well. British socialite Ghislaine Maxwell faces years in a prison that's likely to be harsher than the so-called Camp Cupcake, where Martha Stewart did time. The ex-girlfriend of disgraced financier Jeffrey Epstein was convicted in New York of 5 counts tied to sexual abuse. Because she was convicted of sex crimes, Maxwell isn't likely to be sent to a minimum security prison camp. Shares of Tesla are lower today after the electric vehicle maker announced 2 recalls. More than 356,000 cars are being recalled because the rear trunk lid may interfere with the rear view camera. Tesla is also recalling 119,000 Model S vehicles because of problems with the front truck latch assembly. And Robinhood is working to let more traders use a feature that rolls options contracts. That would allow them to close out a position and simultaneously open a new one. At Robinhood, options activity brought in about 61% of the firm's third quarter trading revenue. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
How does an extra $1 trillion in spending not increase inflation?
By increasing the productive capacity of this country. And that's a very important thing that we, frankly, have not successfully done across most of my lifetime. You know, I've been waiting for this legislation for months since I became Transportation Secretary, but various presidents have been hoping to reach this day for decades, and it hasn't happened for all kinds of reasons. The American public has been rightly impatient. Now we're getting it done, both making up for lost time and laying a better foundation for the future. Let me also point out to the fact that Part 2 of the President's agenda, what I like to call the big deal. But Part 2 of that, the Build Back Better Act, has even more that will help beat back inflation by lowering some of the costs that Americans feel most acutely, the cost of childcare, the cost of health care, the cost of housing, the cost of prescription drugs, bringing those down while also making sure that we ease some of those labor market issues we have by making it easier for working parents to afford to go back to work.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
The
retail inventory to sales numbers have still just really made no headway from the outright collapse that we've seen over the past year. And so this is the start, but I think we're still going to be dealing with these supply issues for the better part of the upcoming years. There's a long way to go in terms of rebuilding those inventories.
Sarah House there, senior economist at Wells Fargo Securities, with Matt Miller and Katie Lyons. I'm Jonathan Ferro, up 9 on the S&P, advancing 0.2%, another record high to close yesterday. Yields in a couple of basis points, down to 153.24, and you have 2 days left of trading in the United States of America as we close out 2021. Matt, I know there's some complaints out there. Why are we open for trading? Never mind tomorrow, but the whole of this week. This is NYSE Rule 7.2. Thank you, Market Watch, for writing up this story, which stipulates that the exchange will be closed either Friday or the following Monday if the holiday falls on a weekend. Good news, unless, quote, unusual business conditions exist, such as the ending of a monthly or yearly accounting period. And Matt Miller, for that reason, will be at work tomorrow.
It sounds like those rules were written up in 1892. I mean,
I agree with you. I agree with you.
It's so arbitrary. I want to reiterate, though, I'm happy to be here at work, and I'm thankful for this job.
He's hoping management is listening.
Who's that for? Who is that message for this morning? You know, management are off too, Matt. They're not listening either.
Yes, although yesterday I was complaining about working during this week, and I got a message from someone higher than me in the managerial chain who said, "Don't you want a paycheck?" Yes, I do.
I share that view. Joining us now, Bloomberg's Kriti Gupta with a chart of the day to keep Matt and I out of trouble. 153 on 10s. I know you're looking at the yield curve, Kriti. What did you see?
Yeah, well, one of the big questions that we're ending 2021 on, essentially, is if we're expecting 3 rate hikes in 2022, why are yields so low relative to that thought process? So that brings me, of course, to the yield curve. I like to look at history for moments like these to see if there's a pattern, John, and that's really what my chart of the day shows here. Essentially, the 2s-10s curve going all the way back to 2010, going and really accounting for essentially the last recovery period, this expansion that you've seen. And I want to highlight 3 distinct parts of that historical timeline that I'm really highlighting. First, in 2013, where we talk about the taper tantrum, 2016 with the Trump election, and then, of course, what we are seeing now. And I'm just going to walk you through those. In 2013, the big question was, do we start to see a hike in monetary policy as signaled by Ben Bernanke tapering? We all remember that's really 2013, May 22nd, I believe, his testimony that sent yields higher, the 10-yield higher in particular. And it kind of created this extreme reaction in the Treasury market, which was then turned around and pared back. You saw a similar reaction with the Trump election in 2016, excuse me, for the 2017 starting of his term. And you saw this massive kind of risk-on behavior after his election, this massive jump in yield, and then it kind of turned around at the start of his term in 2017. You're seeing a similar thing now, because at the end of 2020, that Pfizer Monday, November 9th, when he got that vaccine news, you saw once again this very extreme move in yield that is now getting pared down. So we are kind of racking our minds talking about, well, what is the fundamental reason for some of these yields to be really so suppressed?
I'm racking my mind with all these dates. How many years did you just give us?
I've given you a lot, but there's a lot of history to get through, so I gotta run through them, Matt. But basically, the takeaway here is that we're talking about fundamentals, how much fundamentals are driving the market, but sometimes it's just technical. Sometimes you're just reversing at a very extreme move, and I'm sure John is cringing right now that I mentioned technicals. But right now, for the yield curve, that seems to be what's driving the market.
But Tom Keene is smiling because he loves historical context, Kriti. He likes to take charts as far back as they go, so you're doing the right thing. At the same time, when we talk about a flatter yield curve, in theory, that's not great for the banks. Yet we've seen a persistently flattened curve, and the financials are up 33% this year, one of the best performing groups in the S&P 500.
They really are, and that's really where you see that kind of massive disconnect, the macro disconnect, because a lot of folks have been saying, well, stock market is taking their cue from the bond market, and they were earlier in the year, and now you're starting to see that dispersion. The question here is that if the bond market, let's say even on a fundamental basis, is perhaps pricing in slower economic growth in 2022, or perhaps the effect of the Omicron variant as shown by the curve flattening, well, the stock market is still hitting record high after record high. So that isn't something that's just isolated to financials where you're seeing that divergence. You are seeing this in the broader market as well.
Is this all built off of 2022 earnings expectations, Kriti?
The stock market, it kind of seems like it is, in addition to operating margins, which have also, if you're starting to look at how much operating margins are their prediction in 2022, the idea, the consensus seems to be that those margins will continue, that a lot of these companies will still be able to pass on those essentially higher costs onto their consumers, which is interesting because that's not what the bond market is saying. The bond market is saying that inflation is still going to be a problem in 2022.
Kriti, awesome, as always. I wasn't cringing at all. Kriti Gupta, thank you very much on this bond market. I was actually reading through this Cathie Wood tweet storm, whatever you want to call it, from overnight, Matt, says the following. In our view, fears of inflation will give way to confusion and fears of recession during the next 3 to 6 months. If so, the rapid growth rates of truly innovative companies, many of their equities maligned this year, should be rewarded handsomely. Of course, Cathie Wood talking her book to some extent, Matt, but an important thought exercise for us all going into 22.
Yeah, absolutely. And you said at the beginning of the week, we haven't been talking enough about earnings, and I think that's very true. We started it off with Ed Yardeni, and I've been talking to pretty much every guest about it since. If we do have 8%, 9%, Gina Martin Adams saying almost double-digit earnings growth in 2022, then that would continue the strength, or you'd think that the market strength would continue, especially if we continue to give it these kind of valuations.
What do you make of that, Kaylee? In our view, fears of inflation will give way to confusion and fears of recession during the next 3 to 6 months. If so, the rapid growth rates of truly innovative companies should be rewarded handsomely.
Yeah, I think it's interesting. And part of that thread, which I have to say is actually quite long, she talks about this being kind of the opposite of Y2K, and that the industries that are being most dealing with these excesses and inventories are the ones that are going to be disrupted by technology, and therefore you're going to see kind of a flippening of what we saw about 2 decades ago. On the growth versus inflation side, John, I'm not sure anyone is too worried about the risk of recession right now. I guess the question is, maybe this is reflected in that flatter yield curve that we were talking about, the fears for growth down the line if the Fed is really aggressive in normalizing policy.
I'll get to that quote, that direct quote, because it's actually pretty interesting from Cathie Wood. This build-up along with M&A and IPOs reminds me of Y2K. This time the excesses are likely to be in industries that technology will disrupt. Energy, financial services, and Matt, she goes on to say, transportation among others. If so, this disruption will be the flip side of Y2K, completing the circle.
I have been hearing about transportation disruption for nigh on a decade now. Ford was on the forefront of this when it set up a mobility center in Silicon Valley. I just don't see us getting away from individual car ownership, and whether the powertrain goes from ICE to electric or not, it looks like it's going to, but I think at a pretty slow pace. That doesn't really change the way the whole industry operates.
Matt, when can I get a subscription to, say, Mercedes and have a self-driving car just turn up on the street for me?
You can get a subscription now. It's interesting that you mentioned that, because I'm actually on the Volvo Cars website. You can get a subscription to a Volvo. So you only pay a monthly fee, but it's not going to be self-driving.
Not as excited about Volvo, Matt.
Matt, are you shopping for cars during the show?
Of course he's shopping for cars during the show. Shopping for houses too. Yields down 2 basis points, 152.89 from New York. This is Bloomberg.
We know that it's highly transmissible. We we know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Protesters breached the Capitol.
Democracy has prevailed.
A flash mob decided to take on the short.
Giant container ship blocking the Suez Canal. 1,000 new types of crypto coins.
Crackdown on tech in China.
In the billionaire space race.
The Delta variant of the COVID virus.
Evergrande is the most heavily indebted developer.
Of the chip shortage.
Withdrawal of U.S. forces from Afghanistan.
We did not get everybody out.
Songs you love.
Rising energy prices.
In Europe, it's a huge crisis.
The Omicron variant has triggered a global rush.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The Fed has probably overstayed its welcome on QE by about 6 months.
There is some limitations in really what the Fed can do given where a lot of these inflation pressures are coming from.
Once they do that rate hike in March, maybe that is the end of the dollar strength.
They're not tightening, they're just moving towards neutral.
I think policy stays in the middle. That's great for markets, it's great for the investor class, it's great for the country. What we don't want is shocks.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
2 more trading days to go from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Katie Lyons and Matt Miller. I'm Jonathan Farrow. Your equity market up 6 on the S&P, advancing a little more than 1/10%. We've had 70, Katie, you've been counting. Will we get 71 and 72?
Looks entirely possible, John. Granted, that still won't bring us to more records than we saw in 1995. It was 77 back then, but still, this is the greatest number of record highs we've seen in any given year in 26 years, John. This equity market dancing around 4,800 at the moment, when even the most bullish on the street a year ago was looking at 4,400. We have blown out expectations.
This annual performance, not just this year, Matt Miller, it's the year before that. The year before that has been absolutely phenomenal. Stellar. 2019 up 29%. 2020, believe it or not, up 16%. And this year, Matt, up almost 28%.
Yes, and I believe you are rounding down as well, because wasn't last year 16.6%? It's been unbelievable, and the question is, can it continue? There are bulls out there who say yes, but it seems just hard to fathom. Even if we have tremendous growth next year, haven't investors already priced that in? And that's part of why we're seeing such big gains On the other hand, you've got investors like the head of Norway's Wealth Fund we talked about who said, prepare for a decade of slower returns.
The relationship between the economic data and the markets is something we need to get into, Kaylee. We've been talking about it over the last week or so. If we all think about our own respective surprises of the year, for me and many others, even if you nailed the market call, or rather nailed the economic call, you might not have got the market call right. The bond market's been fascinating in that regard, in that respect, with inflation close to 7 and 10s right now at 152.72.
Yeah, far lower than anywhere we expected to be, given the inflation outlook, given, frankly, the policy outlook, John. There has been a massive disconnect between the economy and what is going on the policy front and the market, but that has been the case really for quite some time. I mean, this was a markup. You were talking about the gains we saw in 2020, that well before even vaccines, we saw this incredible rally off the bottom. I believe it was the quickest return back into a bull market we had seen, on record? There's some extent of animal spirits here, regardless of what's going on with the economy, John.
What a run it's been. NASDAQ futures this morning up 29, advancing 0.2%. S&P 500 futures up 7, advancing 0.14%. Into the bond market, yields lower. We head south. We're down. We're negative 3 basis points on the day to 152.38. Crude 76.24, negative 0.4%. And euro dollar not doing much. 113.35, down a little more than 0.1%. Joining us now, one of the best on the street, Steve Whiting, Chief Investment Strategist and Chief Economist at Citi Global Wealth Investments. Steve, I want to start with a quote from Cathie Wood. The team and I were talking about this about 5 minutes ago. It reads as follows. In our view, fears of inflation will give way to confusion and fears of recession during the next 3 to 6 months. If so, the rapid growth rates of truly innovative companies should be rewarded handsomely. Steve, your thoughts on that quote?
Well, look, I think we're going to have some growth fears, which we should when we have faced a real threat, which is inflation. But I think it will come down, and if it does, it's likely to help the expansion be sustained. It'll be at a slower pace. We will not see a repeat of what we had in the last 2 years. You're all talking about these rate returns. The COVID shock itself was extremely narrow and severe, and the policy medicine was incredibly widespread. It was destined to get us a powerful return in markets. It's been consistent with record high corporate profits for large firms, so therefore share prices did what they did. And when we look going forward, it's going to be a different environment. It's going to be an environment where we're trying to restrain all of the stimulus. And consequently, I think equity returns will slow as well. So the question will be, will innovative companies be rewarded in that environment? And they probably will over a longer period of time. But we're probably, most importantly, going to see investors need to focus in on generating income in portfolios. And that means, again, some of the more higher quality, stable companies. We're not saying to take out any of the innovation portfolios, but definitely put in a little bit of caution within equity portfolios.
How do you define quality, Steve?
Well, this would be earnings stability, dividend growth, consistent income flows. The firms, again, that are not necessarily taking moonshots, but have very, very steady cash flows that they pay out to investors at a higher premium return than bond market yields.
So not a lot of growth, or do you think you can get quality growth as well?
So I don't really think, for example, growth and value metrics have been really, really good ways to drive portfolios. We've really needed to look at cyclicals and defenses. And what we wanted to do, after having a period in which many of the cyclical shares have outperformed by double digits, where we think that we're at peak cyclical momentum, we're actually passing it with factory orders, for example, near the highest levels we've ever seen. That you want to, again, think about some of the more stable industries. Our largest overweights are in healthcare shares. We think that consumer staples, which suffered the rise in commodity prices over the past year, will start to see that negative drag ebb, and they can catch up some in performance while paying some high dividends. Now, if we take a look beneath the surface, again, we do think that there are unstoppable trends that have suffered from the rebound in cyclicals in terms of relative performance. Think about alternative energy or fintech or cybersecurity, these really long-term performers, which have a good performance over a few years, but weren't, for example, energy or banks in 2021, which had the rebound effect. That some of those shares, again, will probably outperform well particularly if you can look at it at a 5-year return window.
Steve, you're thinking about your coverage, your allocation, exposure across industries. Walk us through how you're thinking about exposure allocation across regions, geographies beyond the United States.
Well, at the moment, it's a bit more overweight the U.S. than other regions, and that's partly because of Fed tightening. Now, I would contrast that a little bit with where we were in 2013 through 2018. That period, again, with the onset of the end of QE, Fed tightening from 2015 explicitly with rate hikes, 9 rate hikes from 15 to 18. That was a period in which the U.S. dollar was extremely weak at the starting point. Oil, petroleum, $100 for many years, while the U.S. doubled oil output. We subsequently had a 65% drop in oil, a 20% surge in the dollar over the course of 2014. That dynamic, we think, is not going to be as severe this time, partly because the dollar is much higher on a trade-weighted basis, on an inflation-adjusted basis, both against emerging markets currencies as well as developed markets currencies. If we take a look at China, for example, its equity market was soaring into the start of Fed tightening. This time it's down 32% at its low point as the Fed begins tightening. So it's a different setup here. I think that international non-US dollar assets will hold in a little bit better, but we've still biased ourselves a little bit here with the defensive growth industries within the US market.
Well, Steve, talking about Fed policy, and we just ran through some FX commodities and, of course, equities as well. In the bond market, can you take your assumptions about what the Fed will do next year, where you think inflation or growth are going, and make a call with conviction on where you think the 10-year will end 2022?
No, not with much conviction, but it's at a rate level that is offering negative real returns, probably out for the decade. You can just take a look at the Treasury inflation protected securities market. We do think that 10-year average consumer price inflation will be on the order of 2.5%. We're not really disagreeing with the bond market. The rise in inflation expectation that we've seen, we think is very realistic. The Federal Reserve and other central banks are not going to try to knock down the trend inflation rate by using recession, again, to opportunistically push down inflation. But even then, we think that the rate of inflation will come down, that there were some unusual aspects to both demand and supply, stimulus and distortions in the past 2 years, particularly 2021, and some of that can come off. So in other words, we think that we can see modestly rising real yields, but this is not compelling enough to get us to really move into safer fixed income. We do have an overweight in tips. We've contemplated reducing it some. It's really been well positioned to get these upward inflation surprises, but now the tips market is at a high valuation.
Steve, got to leave it there. As always, buddy, thank you. Thank you for everything this year and this morning. Steve Whiting of Citi Global Wealth Investments. Matt, a call from Citi on a single name. On General Motors, some upgrades here to price targets. This on GM from Citi to 96 from 90. Bullish, obviously. The quote, a more positive view on U.S. supply demand and GM's looming product cycle. That stock yesterday closed at 57.23. They're looking for 96, Matt.
Yeah, well, GM and Ford both seem to be a little bit late to the game when it comes to hybrids. Of course, Ford a few years ago went completely away from cars and is only producing trucks and SUV crossover vehicles. Ford just a couple of days surpassed General Motors' market cap for the first time in 5 years, as they have the power boost in the F-150 and they're coming out with the Lightning. GM, on the other hand, has the Hummer coming out, and it may not be the same kind of broad acceptability as you see with the F-150.
Matt, have you thought much about the second-hand market at all, given the battery replacement costs? I mean, aren't you taking a big risk buying one of these cars in the second-hand market down the road?
Yeah, it would bother me if it's difficult to swap out the battery to buy an electric vehicle.
Sounds like lease in the future. You and I can talk about it in a moment. Futures up 8, advancing a little more than 0.1% from New York. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. Today will be the second time this month that the leaders of the US and Russia have talked. The White House says that President Biden and Vladimir Putin will discuss a range of topics, but the issue of Ukraine is likely to be prominent. Earlier this month, President Biden told Putin that Russian aggression against Ukraine would be met with unprecedented economic penalties. A new study on the Johnson & Johnson coronavirus vaccine is welcome news for Africa. 2 doses of J&J's shots slashed hospitalizations caused by the Omicron variant in South Africa by up to 85%. The J&J vaccine is increasingly being used across the continent. U.S. Secretary of State Antony Blinken is calling on China to stop arresting Hong Kong journalists. That comes a day after the biggest remaining pro-democracy news organization there, Stan News, shut down following a police raid. Blinken said that journalism is not sedition and that a free press is key to Hong Kong's future as a financial hub. For the 5th year in a row, Goldman Sachs was the #1 advisors on mergers and acquisitions, and it came during a record year for deal-making. Goldman advised on more than $1 trillion worth of deals, giving it a market share of more than 24%. The bank collected more than $4 billion in fees in the first 9 months of the year. That easily beat Goldman's rivals, JP Morgan Chase and Morgan Stanley. And the chairman of Credit Suisse reportedly broke quarantine rules for a second time. According to Reuters, Antonio Ortozario attended the Wimbledon tennis finals in London in apparent contravention of UK rules. Earlier, Ortozario was said to have flown out of Switzerland when he should have been in isolation. Credit Suisse isn't commenting on the matter. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
What do we know and what don't we know? Because there's a lot of speculation, a lot of anecdotes circulating right now.
Omicron definitely has the characteristics to create us concern for many reasons. But also we have been preparing for a moment like that for months right now. And I feel comfortable that the playbook will work. So what is the playbook? One, it is to understand more about this virus. The second, of course, will be to protect against infections. And the third is to treat. Let's take it one after the other to understand. I think there are a few things that are not very clear yet with Omicron. One, it is the clinical manifestation of this new variant. Is it creating more severe disease or not? Is it transmitted easier or not? Is it going to younger or older people? All of these are things that as we see clinical cases coming out and the numbers are getting bigger, that's something that we will know in a few weeks.
Protesters breached the Capitol.
Democracy has prevailed.
A flash mob decided to take on the short.
Giant container ship blocking the Suez Canal. 1,000 new types of crypto coins.
Crackdown on tech in China.
The billionaire space race.
The Delta variant of the COVID virus.
Evergrande is the most heavily indebted developer.
Of the chip shortage.
Withdrawal of U.S. forces from Afghanistan.
We did not get everybody out.
Songs, you lie.
Rising energy prices.
In Europe, it's a huge crisis.
The Omicron variant has triggered a global rush.
container ship blocking the Suez Canal. Types of crypto coins.
Crackdown on tech in China.
The billionaire space
The
race.
Delta variant.
Chip shortage.
Rising energy prices.
The Omicron variant has
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
I think it's going to be a good outcome for inflation. I don't think it's going to return to our 2% Fed target. In fact, I think it's going to stay elevated around 3% in the balance of this recovery. But I do think it's going to moderate next year, and that's going to calm fears of runaway inflation.
Great range of guests to close out 2021. That was Jim Paulson, the Chief Investment Officer at the Luthold Group, with Matt Miller, Katie Lyons, and Jonathan Ferro. This is Bloomberg Surveillance, and here's the price action. Up 6 on the S&P, advancing a little more than 1/10%. On the Nasdaq 100, up 25, advancing 0.15%. Yields lower by 2 or 3 basis points on 10s to 152.38. A big feature of 2021 has been the discipline of commodity players. Typically, over the last several decades, you put up a price, they'll dig you a hole, they'll pump more crude, they'll extract more copper. It is different this time around in many ways. I want to discuss that now with Janine White, the Senior U.S. Integrated Oil and E&P Analyst at Barclays. And Janine, I want to start with your quote right here on discipline. We don't think companies will chase production at the expense of returns if inflation runs ahead of expectations. Janine, can you build on that line for us, please?
Sure, Jonathan, thanks for having Barclays on. Inflation concerns continue to be rampant. And even in the last segment, I know you talked a lot about it. But we think inflation in 2022, it's really going to put a spotlight on both capital discipline and on efficiencies. And so most investors, they think inflation will exceed the 10 to 15% that our companies have been talking about on the last earnings call. Higher inflation equals higher CapEx equals less free cash flow, and that's clearly bad. But, the name of the game in energy, it's still very much capital discipline. And therefore, we just don't think that our companies are going to chase production growth at the expense of returns if inflation runs ahead of what they expect. The wild card is really efficiencies. Companies still think that they can offset some inflation with internally generated efficiencies. But, we're kind of in the later stages of that for the industry. And so there's a lot of skepticism on that.
How does all that feed into your expectations for dividend payouts and buybacks, Janine?
Well, the key, again, is it's capital discipline. And if you have capital discipline, we have a very positive view on what payout yields will be next year. On average, for our coverage list, it's about 9%, which is a really attractive proposition for investors.
And when we're talking, obviously here, when we're talking about capital discipline and the prospect of returning cash to shareholders, do you have to have shareholders? Do you have to be a public company? What differences are we seeing in the public behavior versus the private behavior, specifically in the shale complex? And do they start to feel pressure if private players are actually drilling more?
That's something that everybody has their eye on. The rig count in the U.S. is a very visible metric. And week after week, we can see the difference between public and private. And the public rig count has been much more modest in terms of its increase. And the private rig count has been pretty quick. We don't think that private companies are held to the same standards as public. And so we think that the private operators will continue to spend more. But we think the public operators in 2022, just like in 2021, are going to be very modest and disciplined. They're really still seeking that low growth, high free cash flow model.
We saw a little bit of activism in 2021. Does the ESG movement make any difference to these companies in 2022?
ESG makes a difference to every single one of our companies. I think it depends on which subsector you look at. So for ESG on the E&P side, those companies are somewhat more limited in what their scope can be. They've already done a great job at reducing flaring. They're going after emissions. Some companies are even starting to look further down the ESG value chain at looking at hydrogen, wind, and solar. If you look at the U.S. integrateds, that's where they can make a bigger impact on that. And we've had large announcements from both Chevron and Exxon, with Exxon spending $15 billion over the next couple of years just on lower emissions and ESG efforts. So it's going to matter to the companies, and we think it matters to investors as well.
You still had this year the U.S. government asking the Saudis and OPEC to please pull more oil out of the ground. How how do you view OPEC production next year and OPEC discipline as well in terms of production discipline?
Well, you know, our upstream call is still positive, and we are clearly married to oil prices. If we look at OPEC plus behavior, our oil strategist Amar is saying he thinks they're still going to remain disciplined next year. We have the next meeting coming up on January 4th, and he anticipates that the taper will either slow or they'll just hold production where it is right now instead of increasing further.
Can we get your top picks for next year quickly? What are the top calls for next year, Janine?
Sure. Our official top pick designation is ConocoPhillips. If you look at payout yields, which we really think is going to drive stock performance next year, we're overweight on Marathon, Pioneer, and Devon Energy. We also think there's a couple of ways to play the inflation game in terms of companies being more insulated. You could be diversified, such as Conoco or Hess. You could have contracts locked in for services, such as EOG and Devon Energy. And then also, size and scale matters when it comes to inflation. So that would be the integrated. Chevron and Exxon were overweight, as well as Pioneer and ConocoPhillips.
The brilliant Janine Way. Janine, thank you, as always, joining us from Barclays on some of these oil stories. And Matt, we go back to the beginning of this conversation. Do you remember 10, 20 years ago, if prices were up, you know what happened? More drilling, more digging. It's different this time around for a lot of these players. Discipline is a big factor in the story.
Yeah, absolutely. Although as prices rise, I think it's interesting right after COP26, as U.S. government officials were talking about climate change, they came back home and then called up OPEC and said, hey, please pull more of these natural resources out of the ground.
You've been way too kind. They were doing it while they were there.
Yep.
They didn't wait to get home, and they were doing it before they went. I think the president was in Rome, remember, at the was it a G20?
I found that ironic. I think even Alanis Morissette would approve of that use. In any case, look, it's very interesting the changes to me in OPEC, and especially now OPEC Plus, and I wonder, Greg Valliere would be a great person to ask about this again, what the geopolitical fallout is going to be if we have continued or elevated problems with Russia.
That's the geopolitical fallout. Let's just talk about domestic politics. For a lot of people, Katie, the road ahead, the year ahead, all goes back to that headline inflation story. For domestic politics exclusively about that headline inflation call, close to 7% at the moment.
It's a huge headache for the Biden administration because we all focus on the core metric, X food and energy, but at the end of the day, the higher prices at the grocery store, the higher price you're paying at the pump is what consumers actually feel, and there's political pressure that comes with that. And we've seen the administration trying to take action to ease up some of the shortages and supply chain issues, tapping that strategic petroleum reserve. But at the end of the day, there's only so much that the president is able to do about inflation, John, and encouraging OPEC to plump more, while it may be contradictory, may be one of really his only options.
You're always going to blame the man in charge. Always. And Matt, I would throw this in there as well. The tone from the administration at times has just been lacking. We've talked about that briefly. Sometimes it's just wide of the mark.
Absolutely. I'll tell you what, though. It's 1 week and 1 day until I come back to New York City, as I've been reminding you pretty constantly. I can't wait to get back to the cheap gas of the United States of America. It's going to be like instantly a 50% cut in what I'm paying for gas here. So as you worry about prices rising at the pump, I'm looking at a huge discount.
It's all relative, Matt. You enjoy the New York City rents too, when you compare them back to what you pay in Berlin right now. You'll have fun with that, no doubt. Futures up a tenth on the S&P. Yields down a basis point on a 10-year, 153.76. With Matt Miller, Kelly Lyons, and Jonathan Ferro, this is Bloomberg.
end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
How fragile is the European energy complex?
The European energy complex has been incredibly fragile for a number of months now, and it just seems to just keep getting hit with new crises.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Just a sprinkle of economic data to close out the year. We get initial jobless claims any second now from New York City. Live on TV and radio with Kenny Lyons and Matt Miller. I'm Jonathan Ferro. Futures up 6, up a little more than 1/10%. Sub 200. There we go. 198,000. Sub 200. The median estimate 206. The previous read 205. Kaylee, they are the numbers we want to see. Sub 200, 198,000.
And that looks like kind of the lowest we've seen in decades, John. Of course, this is the week that ended December 25th, so there is some holiday impact here potentially. But this is still, I mean, the labor market recovery is chugging along and chugging along quite quickly.
Matt Miller, that's one heck of a number. We want to see more of that, but that's good to see. 198K.
Yeah, absolutely. I mean, what the Fed is focused on, though, and what I think, Tom focuses on a lot here on this program is the labor force participation rate. And that still hasn't come back to pre-pandemic levels. And that's what the Fed is trying to focus its policy on, especially certain groups that have had real trouble bouncing back. And you're going to see, I'm sure, the new nominees also especially focused on those issues.
Hopefully we get those Fed picks pretty soon. Doesn't look like we'll get it before the end of the year, maybe at the start of next year, maybe next week. Getting some data on U.S. retail foot traffic as well. Here's some interesting numbers put together with Bloomberg's analysis of mobile phone location data collected by SafeGraph. U.S. retail foot traffic rose 36.9% last week from a year earlier. So year-on-year stuff, Katie, but improvement. That's what you want to see, up 36.9% year-over-year.
A lot of people may be getting in the last-minute holiday shopping, John. But yeah, that's a consumer that is out and spending, even in the face of the threat of the Omicron variant, even in the face of higher prices. So far, we have seen that the propensity to spend has not yet really been hit by that.
Let's get to the analysis. Yelena Shuracheva, the senior U.S. economist at Bloomberg Economics, joins us now. Yelena, your response to a sub-200K read on initial jobless claims?
Okay, perfect number, and I think the seasonals were expecting an increase in the week and the holiday week. which did not materialize. And I think that just shows you that companies are really eager to keep their existing labor force in place. The number I look at in this report is the insured unemployment rate, which actually dropped to 1.3%. This is the number of people who are getting unemployment insurance as a percentage of the labor force. This is just 0.1% lower or higher than the lowest level before the pandemic. That tells us that we are going to hit the 3.5% unemployment rate pretty soon. And in fact, the bar is so low for that even with moderate improvement in jobs, we will hit 3.5% probably by the middle of next year.
Yeah, and Elena, I should correct myself earlier. I said that was, one of the lowest. It is one of the lowest prints we've seen in decades, but we did get that 188 handle earlier at the beginning of the month and then 194 back in November. We look at jobless claims that are continuing to trend lower. As you say, the unemployment rate as well, 3.5 is what we're now realistically looking at, and yet you're still seeing stubbornly low participation. Are we starting to understand the structural changes in this labor market where you can have not as many people seeking jobs and unemployment benefits simultaneously?
I think we are going to see continued sluggishness in the participation rate recovery, unfortunately, and 3.5% this time around is not the same as 3.5% back before the pandemic. But nonetheless, it will pretty much satisfy the definition of full employment the Federal Reserve is looking at. So the number of people who are looking for jobs as a percentage of labor force, that will be perfectly fine next year. So that will prompt the Fed to hike rates in 2022.
Well, when we last heard from the Fed as well, the chairman made it very clear that they are able to act on inflation without necessarily having fully met their employment part of the mandate. Do you think that the employment data even matters right now, or is it really just the inflation front and reacting to that?
I think that the focus has absolutely shifted away from the labor market, which is improving quite rapidly, and the focus is now clearly on the inflation side of the story.
I want to ask your take on a question John's been asking me all week. I don't know why. Is it possible for the Fed to fight inflation without negatively affecting economic growth?
I think it is, at least in the beginning of the process. I think it's pretty much priced in and set in stone for the Fed to start tightening policy. The question will become a little bit more interesting by the end of next year as we sit here and talk about the prospects for 2023. That's going to be a little bit more difficult. So I think we will see 3 rate hikes next year at least. But as inflation starts to slow down, our projection is for 2.8% by the end of next year. And as a lot of more hawkish members of the FOMC rotate off the voting roster at the end of 2022. So we will see, face some difficult questions about what happens in the year of 2023, especially with the new board members joining the Fed.
So what do they do that triggers a tightening of financial conditions? I mean, is it about the taper? Is it about unwinding the balance sheet? Is it about raising rates? I mean, how do they gauge how they're affecting FCON?
All of the above, but first of all, I think they need to really talk tough, and that's what they've been doing. Chair Powell at the latest press conference said that the way they already communicated to the markets, it's already starting to show in some data. I think they need to really be vigilant. They need to talk tough that they will fight inflation no matter what. And we'll see by the end of next year what happens. It will, depend a lot on what the markets are doing, the flatness of the yield curve, and economic conditions, obviously. Our projection is for pretty solid growth going into next year. We see growth in the vicinity of 4% by the end of 2023. This is way above potential. So the economic conditions are there. So if you're talking about the data, last week we received the personal income and spending report. A lot of people talked about real PCE being flat, but services recovered pretty well in that report, and it was right there. And this is what we're going to see going into 2022 as well.
Well, Elena, I'm glad you brought that up, because obviously flat spending when adjusted for inflation was something we all focused on. And as we talk about demand, obviously Fed policy can influence demand, but even independent propensity tolerance of higher prices is going to start to wane.
Not necessarily. Again, I think that November PCE report serves as a good template of what we are going to see next year in terms of consumer spending and consumer strength. So far, we have seen a significant recovery in goods spending, but what we haven't seen so far is a significant recovery in the services spending. And this is what we call rotation into services. We have talked about it for a while, but a lot of savings in consumers' pockets, that they're still there, 2.6 trillion. And, more wealthy households are going to spend on services. Not necessarily on goods. We may see goods spending kind of slow down in 2022.
When do you see those, Yelena, when do you see those retail savings burnt off? I mean, do we go through them in 2022, or do Americans become frugal savers?
I doubt it. Well, just considering myself, I don't think I'm going to save that much. But I think we are going to see that deflate quite significantly in 2022. We don't have any more special programs, unemployment insurance and things like that will continue to add to those savings. If you look at the savings rate, it's pretty much back to the levels we saw pre-pandemic. So we will go through quite a significant portion of those savings next year, I believe. And this will continue to support spending, and especially the focus, I think, will be on experiences, on services. So recreational services, if the big if is obviously the virus. So if we continue to see the spikes in infections and things like that, that will hold back the recovery.
You sound like Matt. You've both got some kids to look after, and I imagine they cost a lot of money. Yelena, thank you. Yelena Shuletseva of Bloomberg Economics. That just about does it for me, Matt. Next time you and I see each other, it'll be in the flesh, Matt, here in New York City.
Well, yes. I'm jealous, though, because you still have an hour of television to do, and you've got one of my favorite guests on. You've saved him for yourself. You wait until Kaylee and I are gone, and then you talk to Mohammed.
Well, it is a separate show, Matt, at 9 o'clock, the Open. Mohammed's going to be joining us. Mohammed Al-Aaron on the year.
Sure.
The year that was. The year that was, what we've learned from 2021, the evolution of his thinking, and a look ahead to 22. And a lot of this comes back to the transitory story. He got ahead of that pretty early. He was calling on the Fed to pull back. They didn't. They've started to pull back now, Matt. What happens next? And I think the difficulty here, and we'll add in this question, we've learned so much about the economy this year. What does it mean for the market call? If you get the economic call right, does it help you make the right market call? We'll discuss that with Mohammed a little bit later. And after that, Matt, I'm done for the year. And before I go, I've said thanks to my audience. I've said thanks to my guests. I need to say thanks to the team. I often describe my job as herding cats. I have to say that job is actually someone else's here at Bloomberg Surveillance. A lot of those people are in that room there, in the control room. I started my career in TV on the other side of the camera. I know how hard they all work in the control room, in master control, in operations, the engineers, the individuals on the floor. Thank you very much to all of you. An easier job this week because the guy that actually needs a lot of hand-holding isn't here. He wears a bow tie. Guess who he is? So an easier job for them this week. Thank you to them all, and a happy new year from New York City. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. President Biden and Russian leader Vladimir Putin plan to talk by phone today on what the White House calls a range of topics. U.S. concern about Russia's military buildup on Ukraine's border is likely to be high on that list. In their call several weeks ago, the U.S. president warned that Russian aggression would be met with unprecedented economic sanctions. The U.S. Navy's costliest warship can finally deploy on its first operational patrol more than 4.5 years after delivery. The USS Gerald R. Ford now has all the elevators needed to lift bombs from below its deck. Bloomberg reported the problem back in 2018. The carrier cost $13.3 billion. Another record number of daily coronavirus cases worldwide. More than 1.7 million people worldwide were reported to have COVID on Wednesday. That's the most ever, and the third day in a row with more than 1 million infections. The higher transmissibility of the Omicron variant is expected to drive records in the days to come. British socialite Ghislaine Maxwell faces years in a prison that's likely to be harsher than the so-called Camp Cupcake, where Martha Stewart did time. The ex-girlfriend of disgraced financier Jeffrey Epstein was convicted in New York of 5 counts tied to sexual abuse. Because she was convicted of sex crimes, Maxwell isn't eligible for a minimum security prison. Thousands of Banco Santander customers in the UK got an unexpected Christmas Day gift. Spain's largest lender accidentally made a $175 million second payment to 75,000 people and firms. They had been due only one payment from 2,000 businesses with Santander accounts. The bank's now trying to get that money back. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Rishka Gupta. This is Bloomberg. When your shares are down 20%, it's got to hurt. But talk to us about, well, really what you're seeing. Take us more forward-looking. Are you worried about people exiting pandemic era and going back to the gym, or are we going to work out at home more?
Well, that's actually the advantage that Beachbody has is we have never been a direct competitor with the gym. In fact, what we rely on is our ability to influence the 150 million people in North America specifically who are overweight or obese and haven't made that choice yet. Our job is to influence them with great content and this combination of what we call the total solution: fitness, nutrition, and community, so that they can tap into this incredibly cost-effective solution that is entertaining and engaging right at home so that they get results. That's our job, is to help the new person engage in healthy lifestyles.
Happy holidays from your Bloomberg family.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy?
Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon. Can ESA help humanity take its next giant leap?
Earnings will be good, stock market will go higher, interest rates creep up a little, inflation will roll over back to the 2-3% level, and it'll happen faster than people think as the shock adjustment rolls out.
Really insightful conversation with David Kotok, co-founder and CIO at Cumberland Advisors, that we had yesterday. He also very focused on this pandemic and on the impact of long COVID, especially, something that we don't often talk about. But obviously, we're talking about this virus a lot. Let's continue to do that with Deborah Fuller, professor of microbiology at the University of Washington School of Medicine. Deborah, since we last spoke, we have seen a change in guidance from the CDC, from a 10-day isolation period to 5 isolation days, 5 days after that wearing a mask. That's if you yourself have tested positive. But for families across the country who have just gathered over the holidays, now know they may have had direct exposure with someone who was positive or are living in the same house as one, and they don't test positive themselves, what does the science say that those people should do?
Right? It really depends on if you're vaccinated or not. So there's 2 different sort of levels. Isolation really means if you did test positive, then you need to self-isolate for 5 days. So say that family member comes home and they start to feel sick and go get tested and they become positive for COVID-19. They should self-isolate within your home for 5 days. And then after 5 days, they can come out with their mask on and hang out with you that way. Now, if the rest of the family members are vaccinated, that means that you know you were just exposed to somebody. If you're vaccinated, you do not need to quarantine, okay? But you do need to go around. If you go out and about, you need to wear your mask for a minimum of 10 days. So that's sort of the recommendation. Now, if you become positive, now you are in the same boat as your family member, and you need to self-isolate.
Well, and some of the other confusing messaging we've gotten out of the CDC, Rochelle Walensky, who heads up that agency, was speaking yesterday saying that there isn't necessarily, the science doesn't tell us exactly whether a positive test actually indicates your ability to transmit the virus, saying people shouldn't get PCR tests after they've tested positive because it may tell you that you're still positive for weeks to come. What do we actually know about the connection between positivity and then giving that to other people, especially with Omicron, that is more contagious?
Right. The PCR test is a test that actually measures the sequences of the virus. And what can happen is that even after you have cleared the virus from your body, you can still have those sequences stick around for quite some time. And so what's happening is the PCR can potentially measure dead virus. So you can potentially come up positive by PCR for weeks, even after you have cleared it. The antigen test is a little bit more specific in terms of it only comes up if you're really shedding some virus. But the difficulty there is that it's not necessarily as sensitive as a PCR test. However, with these self-home testing, if you can take that on, say, a daily basis, the repeated testing of it and repeated, say, coming up positive or coming up negative, that's going to provide much more assurance and confidence of whether you're positive or negative.
It seems to me you should just use conservative common sense and then we'll all be okay. I mean, obviously,
yeah, exactly.
If you just spent the holiday season with somebody who tested positive, you should chill out for a while and probably wear a mask when you're out and about. I wonder about long COVID, Deborah. What do we know about people who suffer, you know, infections or disease that might indicate infections that have gone beyond the respiratory system?
Exactly. Yeah, this is the big unknown right now. There is a lot of research going on right now to understand better what are the causes, what are the mechanisms underlying long COVID. We do know that a virus infection does cause inflammation, and sometimes inflammation, even long after the virus has cleared the body, can persist and it sort of has a feedback loop that can continue to cause inflammatory responses in any part of your body. And to some extent, we believe that is related, long COVID may be related to this durable inflammatory response, but we really don't know for sure. And so that's really an area of ongoing study, and we're going to learn more and more about it. And certainly, one of the big reasons why I tell people you really do not want to get this virus. It's something that you don't know long term how that's going to impact your body.
Although, isn't it likely that we all are going to get this virus? I mean, especially now that we're seeing numbers approaching 2 million new infections globally in a single day, and we've seen that now 3 days in a row. Mm-hmm. Are we not all going to get, most of us going to get this? I mean, Angela Merkel, I remember, and not only was she the Chancellor of Germany, but also a PhD in chemistry, at the very beginning of 2020 said 60 to 70% of the population is going to get this.
Yeah, especially with Omicron being so widespread and so massively transmissible, there is an expectation the majority of us will get exposed. Will we all come up positive? Will we all get long COVID? Really, to a great extent, vaccination is going to make a huge difference there. We've seen that, when you get vaccinated, that you're able to recover much more quickly, that there are a lot higher chance of having, if you're come up positive asymptomatic infection. So vaccination really does help to more effectively clear that virus from the body and control that inflammatory response that typically arises in response to the infection.
All right, Deborah Fuller, University of Washington School of Medicine, thank you so much for sharing some time with us this morning, this week, really, and throughout the year. Happy New Year to you and yours. And Matt, I think you raise a really interesting point. At the beginning of this pandemic, we're talking about reaching herd immunity. At what point do we reach that threshold? It has always been a moving target, but now is it something that isn't actually feasible at becoming a reality?
Yeah, well, I don't know about herd immunity, but it does seem like a very large portion of the population is going to get this. Now, the problem is we know that you can be reinfected, which we weren't really sure about, remember, at the very beginning of this. So you could get it over and over again. It'll be interesting to see how bad those infections are. Maybe this becomes something like the common cold or the flu, as a lot of people have been saying. It'll also be interesting to see if they develop a kind of pan-coronavirus vaccine that is hopefully more effective than the flu vaccine and can address all different kinds of variants.
Yeah, the question is, when will that be coming? Will we all be getting boosted till oblivion, or will we eventually have a one-size-fits-all vaccine? I think it's a really interesting question, as Omicron is the variant we're all focused on now, but it could be a different one 2 months from now. This virus has has proven to be very, very capable of mutating very, very quickly. And, who knows what's coming down the line, Matt? Not to be a downer right at the end of the show.
Well, no, I don't think it's not such a downer. Also, booster to oblivion, is that really so bad? I mean, people continue to bring that up as if it's a horrible worst case scenario. I don't mind if I have to get a booster every 6 months for the rest of my life. There are plenty of other chemicals that I ingest on a daily basis. And, better living through chemistry.
It's a fair point, Matt. I have to say, though, I have never reacted so poorly to any vaccine as I did to my COVID booster shot. So they may have something to do with that. That's going to wrap it up for Matt and I here on Surveillance. Futures in positive territory, 47.90 on the S&P. We could be looking at the 71st record high of the year on the second to last trading day of 21. On TV and radio, this is Bloomberg.
energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Protesters breached the Capitol.
Democracy has prevailed.
A flash mob decided to take on the short.
Giant container ship blocking the Suez Canal. 1,000 new types of crypto coins. Crackdown on tech in China. In the billionaire space race.
The Delta variant of the COVID virus.
Evergrande is the most heavily indebted developer.
Of the chip shortage.
Withdrawal of U.S. forces from Afghanistan.
We did not get everybody out.
Songs you love.
Rising energy prices.
In Europe, it's a huge crisis.
The Omicron variant has triggered a global rush.
Protesters breached the Capitol.
Container ship blocking the Suez Canal. Types of crypto coins.
Crackdown on tech in China.
In the billionaire space race.
Delta variant.
The chip shortage. Songs you love.
Rising energy
It's a
prices.
huge crisis.
The Omicron variant has triggered.
How will pricing have to adjust or not as a result of your greener ambitions?
We ran a big survey around 32 countries. More than 30,000 people took part. And as you say, there was a big gap between people that were worried about climate and people that were taking action.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
How many times have we said this? Coming into Thursday at all-time highs. From New York City this morning, good morning, good morning. Your equity market up 6, advancing a little more than 0.1%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York, we begin with the big issue, the lessons of 2021.
The big lesson of 21.
Don't fight the Fed.
Same lesson it's been for the better part of a decade.
You need to be patient.
Have a flexible mind.
This was the year we finally saw real economic inflation show up.
In January, if we would have come out and said 6.8% inflation at the end of the year,
you probably would not have predicted a 10-year treasury at 1.5%.
You would have thought that markets would have reacted wholly differently.
Even with perfect forecast.
Even if something is 70% consensus,
you would have been wrong.
Humility is very critical for success.
Even if something's expected, guaranteed 3 in 10 people are being surprised.
Make sure that you keep your fear contained.
That's just a key thing to consider as we go into next year.
Joining us now, I'm pleased to say, is Mohammed Al-Erin of Bloomberg Opinion and Queen's College, Cambridge. Mohammed, I wanted to start with the arc of your thinking through 2021 and just go through a series of stories with you. It started out in spring, in and around March, April. Did the Fed shift policy lanes at the wrong time? Then through to April, the Fed should start tapering, but it won't. Then into May and the FT, the US economy is evolving, so should the Fed. At the end of June, the Fed, the inherent instability of the Goldilocks market consensus, you said too much confidence is placed in the view that inflation rises will be transitory. And from June into the summer, Mohammed, you beat the drum really, really hard. This was not going to be transitory. The Fed was behind the curve. So let's start here. What was guiding you through this year, Mohammed? Because at the start of 21, it wasn't your baseline, but it quickly became the story for you.
Yes, Jonah, thanks for having me. What guided me is talking to people on the ground, something that the Fed should be doing more of. Talking to CEOs, hearing them tell me that the labor shortages, that the supply chain disruptions weren't going away, and explaining to me why they would last well into the year. And when you hear that from one CEO after the other, in one sector after the other, it's a very clear message. And unfortunately, it's a message that the Federal Reserve didn't hear early enough.
Do you think they hear that message now sufficiently? Is that your interpretation of the pivot that we've witnessed over the last month or so?
So I always say better late than never, but let's not kid ourselves. They are still way too stimulative for what developments are and what forecasts are. So if I were them, I would accelerate even more the taper so that I don't risk a big policy mistake in the middle of next year. So yes, it's good news, John, that they have pivoted. I wish they had done it earlier, but they're still behind the curve.
Given where real rates are, deeply, deeply negative, Mohammed, they are still highly accommodative, as you point out. I'm trying to understand when they start to become more restrictive. It's certainly not after one interest rate hike, may not be after 5. Mohammed, where do you think they become more restrictive, where their policy actually ends up seeing tighter financial conditions?
And that is the big question. We don't know. And that's why you want them to start early and go slowly, because we're trying to find that point. You know, ironically, even though they've pivoted, even though they have accelerated that taper, financial conditions have loosened, John. They've actually loosened, which shows you that we're nowhere near the point where policy is having an impact.
You said that if they go earlier, they can go slower. If you think they're going later, do you think they're going to have to go quicker as this year picks up in 22?
That's my biggest fear. That is absolutely my biggest fear. And that's why I've been advocating since last April that they should have started, is you don't want them to have to hit the brakes hard. Look, we're just easing our foot off the accelerator. So the last thing you want is for them to have to pivot really quickly to a hiking cycle, because remember, they're dealing with an economy and they're dealing with a market that has been conditioned for years to live with floored interest rates and massive and predictable liquidity injections. So this is quite a change, and that's why you don't want the change to be too abrupt.
Mohammed, you and I sat together, and it was in London, it was not in New York, just before the Fed was about to embark on its last tightening cycle. And I asked you to characterize what you might expect, and you said to me, I expect the loosest tightening ever by a central bank. Let's start there. How would you characterize it this time?
So it's harder this time because we have inflation. That's why the inflation call is so important. When we didn't have inflation, the Fed could end up being loose for long and nothing would happen other than elevated asset prices. Now with inflation, we are seeing behaviors change. You know, it drives me crazy when someone said on your show the other day, we're going to be transitory for longer. Well, transitory for longer doesn't make any analytical sense because behaviors change. And we're seeing that. We're seeing price setting behavior change. We're seeing wage bargaining behavior change. We're seeing consumption behavior change. So what's different this time around, John, is that inflation is changing behaviors. And the Fed has to be very sensitive to that.
Do you think they need to be more flexible about sequencing as well, Mohammed, when it comes to policy? Before you know how it worked, it was tapering, it was into rate hikes, then it was into balance sheet reduction. But that balance sheet reduction was largely just, let's allow things to roll off the balance sheet, cease reinvestment. Do we have to rethink the sequencing, the idea that we pull back differently when they start to move?
So I would, you know, I see a case for them to do QT, as it's called, before they raise rates. Right? I really do. However, they won't, John. They seem to be captive, cognitively captive. And I've said this to you before. They were cognitively captive to their monetary framework, which was fine for a world of deficient aggregate demand, doesn't work in today's world of deficient aggregate supply. Then they became cognitively captured by the notion of transitory. And now they still think that a playbook that was designed for the world of yesterday will make sense today. You know, I hope they become a little bit more humble and open-minded, because there's a lot at stake here. And it's not just economic and financial, it's way beyond that. The poor in particular will suffer the most if they get this wrong.
Mohammed, that final point I think is so important, so let's explore it together. There is this view that people who do not advocate for low interest rates, they also don't advocate for full employment, for the recovery from the weakest in society. Just this idea that you need to stay down here to allow things to burn hot, to have a more inclusive recovery. You push back against that. Can you walk us through it and why it's dangerous to maintain this belief that you have to advocate for zero interest rates to be able to advocate for full employment?
Yeah, John, I think what people don't realize is that the environment matters. So if you were, as we were in the past, in a globally disinflationary environment, which we were, then you could stay loose for longer and try to raise everybody's living standards. And that made sense, and I was actually supportive of that. What doesn't work is when you have a global inflationary environment and you try to do that, because ultimately what you're going to do is hit the most disadvantaged segments of the populations in two ways. First, by inflation, and there are studies now that show, I think beyond any doubt, that inflation hits the poor the most, and we hear it already with what's happening to food price, to gas prices. And then secondly, after they've been hit by inflation in a bigger way, they get hit by declining economic activity and losing jobs or losing wages. So you don't want that to happen. You don't want to hit them twice. And that's what I'm afraid is a high risk right now.
So help me understand then, and help our audience understand, Mohammed, if they start to hike interest rates, if they start to reduce the balance sheet, how that helps. What does that achieve?
So it achieves a sustainable path. You know, there's an old phrase that macro stability isn't everything, but without macro stability, you have very little. So macro stability is a necessary condition. And I've always said that the policy response should constitute, first, the Fed going faster in taking its foot off the accelerator, so doing taper faster and a bit of QT and maybe rate hikes. Second, we need to do more on the fiscal side to increase labor force participation, to increase productivity. And then third, we need to be more serious about understanding and supervising probably the non-bank financial sector. That's the elements of a package. It is feasible, it just needs implementation will.
Let's set up the following segment, just with a little tease. Work with me here, Mohammed. We've talked a lot about the economy, a lot about your prescription for this Federal Reserve. You've nailed the call on the economy this year, particularly on inflation for 2021. Mohammed, has that been helpful as it informs your market calls as well? Because what I've struggled with is when I look at even the most accurate forecaster in this economy right now, it would not have helped me predict where 10-year yields are ending the year. So help me work through this, your understanding of the economy and how it informs your view of what's been developing in financial markets too.
So it's been a massive decoupling because the economy hasn't really mattered for financial markets. What has really mattered for financial market is liquidity injection. And if you can bet on the liquidity wave continuing, which was the correct bet, you get the everything rally. So, you know, this year, last year, the year before has been all about liquidity. It didn't really matter what the economy does. It didn't really matter what credit risk does. As long as you got the liquidity call right, you made money. And I have said over and over again, you ride the liquidity wave for now. You have to be tactical. I never guessed, John, tactical would last so long. Tactical has been a really, really long time. But there will come a time when you'll have to pivot from the liquidity issues to the more fundamental issues. And I think that will be 2022.
Let's talk about 22. You wrote this morning in a Bloomberg opinion column, there is an underappreciation of the current inflation dynamics, from the ability of Democrats to retain control of Congress to the damaged credibility of the Federal Reserve. The 2021 inflation surprise will reverberate throughout 22. We're going to talk about this a little bit more in the following segment, Mohammed, but how do you think this is going to reverberate through financial markets in a way that it did not this year?
So your introduction to your show was great because people said, who would have guessed that you would have inflation at 6.8%, you'd have the 10-year at around 150, and you would have 70 record highs on the S&P, including yesterday. That's the dilemma, is will this trifecta last into 2022?
Mohammed, the conversation is going to continue with you and I as we talk about 2022 in the following segment. Mohammed also writing this morning in Bloomberg Opinion the following: the evolution of inflation and China's investability constituted big surprises in 21, as did their lack of spillover into other areas. It remains to be seen how benign last year's surprises will stay for the global economy and for markets. That conversation's coming up next. Coming up, investor sentiment in China deteriorating amid a host of headwinds.
Post-Olympics, by the end of this winter, I think China will sound even more belligerent on Taiwan. I think that U.S.-China relations will stay very rocky.
That conversation still ahead from New York. This is Bloomberg.
When you talk about the commercial viability, the idea that these companies can actually make money off of this here, does this become, I guess, something that's niche in the sense that you have to pay several $100,000s to do it, or does it come back down to a level where just regular folks like you and me will somehow find a way to be able to take a trip up, and this can be a business model that will be sustained?
I think it's important to note that space tourism is a small segment of the overall global space economy. Space tourism accounts for $1 billion of a global $350 billion global space economy.
What's the rest of it?
$260 billion of that is satellites, manufacturing them, launching them. And these satellites we use in our everyday lives, whether that's to listen to the radio, to watch Bloomberg on our satellite television, or to navigate us to our destination via GPS. And I hope in the near-term future, we will add getting our internet from space.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
If China keeps trying to fight the pandemic just by shutting down everything, then that could be bad news for the Chinese economy at the moment. They certainly need to do something to lift the sentiment at the moment, because as we've just seen from the latest data, consumer sentiment is not great.
Beijing's corporate crackdowns weighing on investor sentiment, Chinese stocks remaining under pressure amid uncertainties over the country's next move. Let's bring in Abigail Doolittle for more. Morning, Abby.
Good morning, John. And yes, this year has been all about that uncertainty around Beijing's crackdown on tech firms in particular, really making that space difficult to invest given the 50% decline on the year. But remember 2018 and 2019, it was all about trade tensions. We may see a return to that in 2022 for another headwind. This is China is essentially issuing a 2022 trade warning saying that they see unprecedented difficulty in stabilizing trade next year, that the favorable conditions in 2021 are unlikely to repeat, and exporters facing higher costs. Now, in terms of the virus, their response, of course, is stricter than ours here, and that is especially true right now with Omicron. Prior to Omicron, their GDP is really starting to fall. In the third quarter, down 4.9%, slowing for a second quarter in a row. Outside of the one quarter in 2020, it is the worst growth that they've had over the last 15 years, including 2008. So the point is here, on top of trade tensions and Beijing crackdown, slowing growth, a poster child for the regulatory crackdown, John, of course, Didi, IPO'd earlier this year, initially popped, now down 65%, being forced to delist. Again, raising that question, is China investable, especially if growth is slowing, as we just showed that it is, and the possibility of trade tensions increasing? A big question for 2022.
Abby, thank you. That story with Didi this year has been absolutely phenomenal. We've been debating for years in this country, in the United States of America, how easy we should be making it for Chinese companies to come to U.S. capital markets and tap them for money, to raise cash. All of a sudden, China made their mind up and that debate in America no longer seems relevant. The Chinese Communist Party have made their call, and made a big call. I would say 10 years ago as well, beyond that debate, a big bearish thesis was exactly what's played out in the real estate market, and we've hardly seen any spillover in the FX channel, into global growth, into US capital markets for that matter as well. We'll talk about that a whole lot more in just a moment. Mohamed Al-Erin with us this morning, I'm pleased to say. He wrote this morning on Bloomberg Opinion, the evolution of inflation and China's investability constituted big surprises in 21, as did their lack of spillover into other areas. It remains to be seen how benign last year's surprises will stay for the global economy and for markets too. Pleased to say that Mohamed's still with us. Mohamed, the China piece of this story, how does it fit in?
So far, John, there were two surprises. One is that China underperformed to such an extent. Remember the amount of people who were encouraging you to go into international markets, to go into emerging markets, to go into China, because China looked so attractive. Well, it turned out that China wasn't attractive because two things happened. The economy started to struggle, but more importantly, as Abby said, the government started intervening. But the second big surprise, John, was that what occurred in China stayed in China. There were absolutely no meaningful spillover effects. And that's the second largest economy in the world. Now, that's a good thing, but will it last? And if people are correct in saying things are going to get harder, then we've got to start factoring in the China impact on the global economy.
Are you starting to see signs of instability, spillover, bleed out from China? You've lived and breathed emerging markets for so many years, Mohamed. Are you starting to see that spillover?
No, I mean, there is some instability in certain emerging markets. You can look at Turkey, where the currency is weakening again and crossed 13. You can look at what happened in Brazil. So there is pockets of instability, but they are homegrown. What you haven't seen is contagion. And that's surprising, John, because there's been a lot of crossover capital, what's known in the trade as tourist dollars. They come in, but they flee pretty quickly. The tourist dollars haven't yet reversed course. And that's been sort of an encouraging development for those of us who believe in the maturation of emerging markets, but it needs to last.
Where China has been a factor in the global economy, even domestically here in the United States, Mohamed, has been constrained supply. You've talked about the situation with excess demand. It meets constrained supply. It's fueled inflation, or at least contributed to the fueling of inflation we've seen through much of this year. There are some people, Mohamed, raising a question about the return of supply at some point through 22. How do you think about that dynamic, Mohamed, that maybe a condition of worries about excess demand turns into concerns about excess supply as the supply chain story recovers through 22?
So it will recover, but it will not recover fast enough for it to be an excess supply issue in 2022. Why? First of all, we still have renewed disruptions to supply chains. Look what Omicron is going to do in Asia. Look what Omicron is doing already in the United States. JetBlue today, John, announced that they're cutting flights well into January. Well, if you try and book a flight, if you find one, you're paying a lot more. So we are seeing supply disruptions all over the place, and it has to do with labor shortages as well. So A, it's not as if the shocks are behind us. And then secondly, companies are rewiring their own supply chains. So it's not as if we're going to go back to what was before, and it takes time to rewire your supply chains. So I do think that the market will respond and that the supply disruptions will lessen, but I don't think we'll get anywhere near an excess supply situation in 2022.
Mohamed, we've talked a lot about the lessons of 2021. We've talked about the things you got right, some of the difficulties you've had calling the market. Even we're getting that economic call right. Going into next year, can we just finish on this as we wrap up the year together? What's the big hope for 22? What are you hopeful, optimistic about, Mohamed, in the global economy for next year?
So there's a lot to be optimistic about, but it needs good policy response. One is we learn to live better with COVID. And that's not just about us adjusting here in the West. It's also helping other parts of the world to step up their vaccination effort. There's also a small window, but it's a window for policy to adjust so that we get an orderly reduction in inflation as opposed to a disorderly reduction in inflation. So there's a lot to be hopeful for, but it requires quick policy responses, John.
Mohamed, before you go, can I just say thank you for your partnership, your friendship this year as well. A great friend of mine, and thank you very much for your contribution to the program through 2021. What a year it's been.
It has been, and let me thank you for your reporting, for your insights. And if the chatter in the street is correct, there's a big birthday coming tomorrow. It's your birthday, and if that's the case, happy birthday, John. Thanks for everything.
We're not going to share the number, Mohammed. Let's not share the number. People think I'm much, much older than I actually am. Mohammed, thank you, sir. Send my love to the family. We appreciate you. Coming up on the program, your morning calls, and later, the S&P 500 clocking its 70th record high to close out 2021. I'm going to let you guess the number. I'm not going to share it with you. Your S&P 500 up almost 28% for 2021. From New York City, this is Bloomberg.
At the Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Five minutes away from the opening bell in New York City this Thursday morning. Good morning. Here's the price action. Up a tenth on the S&P, on the NASDAQ. Pretty much unchanged on the Russell as well. Switch up the board and get to the bond market. Your picture for next year, 150 the call from HSBC. Year-end next year on the 10-year, 260 over at SocGen. Someone's going to be close to right, someone's going to be very close to wrong. 152.38 on 10s right now. HSBC closer to that call. SocGen looking for higher yields. That's the bond market, but let's get you some morning calls. First up, your call this morning from Citigroup, raising its General Motors price target to 96. The analyst optimistic on Q4 trends and electric vehicle launches. We're positive there, 0.5%. Your second call from D.A. Davidson, raising its Lowe's price target up to 292. The analyst reflecting a forward roll in valuation models to expected 2023 earnings. The stock is positive, about 1/3%. And finally, Baird lowering its price target on Peloton down to 70. The analyst less confident in near-term estimates and lowering his subscriber estimate. The stock is negative 0.4 to 34.42. Coming up, stocks continue to climb the wall of worry. The S&P 500 closing at a record high on nearly 30% of trading days in 21. From New York, this is Bloomberg.
you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Around about 20 seconds, 23 seconds, 22 seconds away from the opening bow from New York is the price action for you. Up 5 on the S&P, advancing about 0.1%. Record high at a close yesterday. The stat master, Kelly Lyons, saying we've had 70 of them, the most since 1995 when we had, I think, 77. There's the opening bow. Switch out the board and get to the bond market. 10-year yields look like this after pushing higher back through 150 yesterday. Up 6 or 7 basis points on 10s in yesterday's session. This morning down 2 to 152.55. Euro dollar had the high of the year in the first week of the year, 123.27. Week 1 at 21. And now, at the end of the year, 113.21 and down 0.25% on the day. Crude, 76.84, up 0.4%. Your opening bow. Right now, your equity market up 0.1% on the S&P, advancing just a little bit. Consumer discretionary down 0.25%. Real estate basically unchanged, top of the pile. Staples, utilities, financials, healthcare, not much price action to speak of. The S&P 500 clocking another all-time high with 21 trading, coming to a close in about 24 hours, 36 hours, whatever it is. G Squared's Victoria Green expecting stocks to continue climbing higher.
If you look at fundamentals of stocks, they're actually very strong. People have, the consumer has good balance sheets. Look at the Christmas spending. Everybody wanted to scream supply chain. We're never gonna, be able to, poor Santa is gonna get stuck in the North Pole and not deliver presents. But we saw massive spending. It was like up at almost record levels according to MasterCard. So you have healthy consumers, healthy corporate balance sheets, growing earnings. You can climb the wall of worry.
Joining us now to discuss, Sarah Hunt of Alpine Woods Capital and Malcolm Etheridge of CIC Wealth. Let's begin with you if we can, Sarah. Your big call for 2022, what is it?
I think valuations are actually going to start to matter a little bit more. I think you have to deal with all of the issues that are coming from the Fed backing down a little bit, which means that the liquidity issue is going away to the extent that it's been pushing a lot of stocks that have not had a great fundamental situation. So I think that as we get into 2022, that's actually going to start to matter.
Malcolm, this year, all about earnings. Next year, is it about multiples?
It probably has more to do with fundamentals and multiples because you'll have a lot more institutional traders participating than retail traders. Like this year, we saw a lot of price action and a lot of participation from retail traders that we just don't expect to see happen again next year. And one key indicator for that is we've already seen interest in trading among our own clients wane, right? So as individuals turn their attention to other things, there's just far fewer clients interested in discussing names like Peloton and Zoom and GameStop and Bitcoin than there were back in the summer, just as there are far fewer people downloading Robinhood's app these days.
What do you think the catalyst is for that, Malcolm?
Well, one thing, we're already talking about the money supply being not as easily accessible, not as cheap, right? So as we talk about the 10-year ticking above 1.5, let's say it gets to 175 and looks like it's going to approach 2, God forbid, right? That then means that mortgage rates are significantly higher than they have been for a while, which means that all these cash out refinances that have been happening that have people spending money at Lowe's and Home Depot and Sherwin-Williams and everywhere else, there's just not people running around the streets with this extra money, quote unquote, in their hands. And that then translates to people not feeling as rich, at least no matter what their home balance sheets look like. They're not participating in the markets because they're now focused on making student loan payments, making credit card payments, making, utility payments, all those things that have kind of been put on pause. Maybe you haven't had to worry so much about it in the last couple of years.
Sarah, can you respond to that? How much of a contribution you think there has been from what Malcolm just described?
Well, what's interesting, it reminded me of the mortgage equity withdrawal discussion that we were having in 2007 going into 2008, because there was a lot of money coming out of cashing out then as well. I think you have had the last couple of years a lot of forbearance on certain payments, and I think that that is going to be an issue going forward because you don't see as much forbearance and you don't see the excess unemployment on the fiscal side that you were seeing. So you have both the Fed backing off and fiscal support backing off, and I think that that is an issue for individuals.
I do wonder what that means for the cyclical parts of this equity market. One airline stock story we've been talking about throughout the whole of this week has been the cancellations piling up over the holiday weekend. That story continues. I want to bring in Abigail Doolittle for more on that. Hey, Abby.
Hey, John. Well, it's interesting because I was thinking of flying to Florida next weekend. Not so much. JetBlue just today canceling nearly 1,300 flights going into 2022. That's about 10% of their total flight offerings on the Omicron disruptions that we have seen more recently. Over the last 5 days, including today, more than 1,000 flight cancellations each day. This as crew are unable to go or passengers also having issues there. But Omicron really disrupting the airlines here in the U.S. for sure. Investors, however, taking in stride. The stocks right now not plunging. In fact, mixed, more green on the screen than not. That could have to do with the fact that the airline index on the year down about 2% versus the S&P 500 up 28%. So maybe investors all year have been pricing in some sort of possible disruption that we are seeing now. One thing is clear, though, these airline companies very much incentivized to get as many planes back into the air as possible. Debt has absolutely ballooned. Delta, their debt has doubled. In 2019, $14 billion, now greater than $31 billion. Again, companies have the incentive to get their planes in the air. Let's see whether or not it happens, though, in 2022 with these Omicron disruptions.
Abby, thank you. What has come back to you, Malcolm, on not just this sector, but more broadly, the reopening story of 12 months ago? If you think back 12 months, looking ahead 12 months, we were all talking about the reopening of the economy, the airlines. That story stalled out in spring, in the equity market at least. Your 10-year yield, that story topped at the end of March, the end of Q1. I feel like we're having this conversation almost again, Malcolm. People are talking about next year, the reopening of let's get back to business. This is the year of normalization, not just in America, but worldwide. Malcolm, what are your thoughts on that dynamic?
Well, we do expect travel to actually be a surprise next year as it becomes a little bit easier to travel. It becomes a little bit safer to travel. People feel more comfortable. We think that that is one place that all of a sudden has become inelastic, right? Airline travel for most people, at least, recreationally, was sort of an elastic good. And now we expect it to become sort of inelastic as we are able to move around a little bit more freely. We have more people vaccinated. We have far fewer people getting hospitalized and that sort of thing. And we do expect that the airline supply will actually raise to meet the demand at some point. So eventually that graph starts to look more in line. Right now, it's completely out of whack where you have far more demand from consumers than you do actual supply from the airlines. And part of the reason that the CDC changed up their guidelines as far as the 5 days versus 10 versus 14 it initially was, is because airlines are saying we can't get our staff back on these planes fast enough to help work with and kind of herd these cats a little bit. We need these people back to work, and your protocols for quarantine are just so tough on them that we can't put people in the sky. And so I think those two things will sort of come back in alignment next year, and you'll still have tons of demand of people wanting to get out and make up for lost time.
Sarah, let's talk about whether that translates into a positive mood in the equity market, the potential for a Q1 repeat in 22, a Q1 21 repeat in 22. Sarah, what's the potential for that?
Well, I think that you absolutely have the sort of pandemic fatigue that people have been talking about. So I think that the excitement when the vaccines were coming last year for the first quarter, I think you're going to, as we get through Omicron, and I think that we will get through it, and I don't disagree that as it gets less severe, people are just saying we're going to go out anyway. Prior to this wave, you had domestic traffic, air traffic, close to where it was before the pandemic. It was international traffic that's still very much curtailed. So I do think that you're going to see a lot of enthusiasm for people to get out and do things because they're tired of staying at home and they're tired of not seeing people. But this particular wave has definitely slowed that down.
I want to turn now to the inflation story of the year, which has been the big surprise for many people in 2021. Not everyone, but for many. Miller Tabak's Matt Maley saying the following: if inflation remains strong, consumer confidence will begin to wane. At some point, the higher prices causing consumers to pull in their horns, and that will hurt profits in our consumer-driven economy. With more on that, here's Bloomberg's Katie Lyons.
Well, John, the profits is really the key part here, because when we talk about what's driving the bullish thesis in the year ahead, everybody points to continually strong corporate earnings. And of course, when we're talking about profits and inflation, what we're really talking about is margins. To this point, margins have held in. They're actually expanded in most of the major industry groups within the U.S. equity market in the third quarter. But companies are still facing higher input costs, labor pressures. All of that can hit the bottom line. And what we're looking at there in white is the 12-month forward operating margin estimate for S&P 500 companies. It has flatlined over the last several months. Really, it all comes down to the ability to pass those costs on. Pricing power is the name of the game here. And staples companies, for example, really trying their best to exercise that. Food prices are expected to rise 5% in the first half of next year. Mondelez, General Mills, Campbell Soup, Kraft Heinz, all saying that they will implement more price hikes come January, and that's benefiting those stocks. They're on pace for their best month in about 20 years. But the thing is, the pricing power only works so long as consumers tolerate those higher prices. And with inflation this high, talking near 7%, at what point, to Matt Maley's point, does that tolerance start to wane, demand start to pull back, and start to pose a threat to profits, John?
Katie, thank you. We've dedicated a lot of time to this story through much of this year, through 2021. Cathie Wood, obviously with skin in the game, has this to say overnight. In our view, fears of inflation will give way to confusion and fears of recession during the next 3 to 6 months. If so, the rapid growth rates of truly innovative companies, many of their equities maligned through much of this year, should be rewarded handsomely. To respond to that, I'm pleased to say that Sarah and Malcolm are still with us. So Sarah, respond to that for us. We've talked a lot about this inflation story, what it could mean for the equity market. Yes, Cathie Wood is talking her book a little bit. Yes, she has skin in the game. But can you respond to what she's got to say on this, that fears of inflation will give way to confusion and fears of recession during the next 3 to 6 months?
Well, if you think about the fact that high inflation, especially in things like food and energy, is very difficult for spending, then you obviously have an issue with what's going to happen with markets, and people will start worrying that the economy is really going to slow down enough. I think she's not wrong that innovative companies will be rewarded, but I think at this point they really have to be innovative companies that can show a path or already profitable, because at this point you don't have the backstop of money being cheaper and completely available everywhere. So I think that's one of the places where there's a little bit of a difference, to my opinion, about what will be rewarded. If we do start to worry about a recession, growth will continue to be rewarded. It's the unfortunate thing for value that it hasn't really had a moment in the sun in the last 2 years.
Malcolm, your response, please.
So I think one of the things that also is getting lost in this conversation about inflation is the fact that we're having such a strong war for talent still at the hourly worker level, right? So we're talking about a lot of the service jobs, those sorts of things that normally haven't really had their chance to fight for higher wages. And we think that as long as the hourly worker is having their day in the sun, so to speak, where folks are competing to get their attention, and even shops, right across the street, right down the street from each other, are competing for workers in smaller towns, the wages continue to grow, and hourly workers are usually the ones who spend faster and more quickly than white collar jobs. So we will see those dollars continue to flood the system and go after goods and services. And so as long as there's more dollars chasing fewer goods like we have right now, because the hourly worker has more dollars in their pocket to spend on consumer staples, especially, the inflation conversation about packaged goods and things like that we were just talking about in the clip before will continue to go up. But if we're talking about, bigger, more grand ideas like Cathie Wood is talking, it really comes back to the money supply part of the conversation. And if those dollars aren't as cheap for corporations to go borrow, it becomes very tough to invest in R&D to see that innovation that she's looking for.
Malcolm, 2 points though, and let's pick up on the first one. It makes me think of margins almost immediately. Are you thinking sector to sector of the labor intensity of each sector? And if wages are going to continue to be seeing this higher pressure, better wages, better growth in them, are you avoiding certain sectors over others?
Well, we're not necessarily avoiding other sectors over others yet, because the companies always have the ability to pass those higher costs on to their consumers. And as long as, like I said, the hourly workers are out there to consume, they have dollars to consume, then nobody's really crying foul too hard about the higher prices. It's when the wages stop growing, right? We stop seeing Amazon commercials where they're advertising a higher hourly wage than anybody else. When we stop seeing those sorts of commercials and the yard signs, you know, in front of the local business, enticing folks to come in for an extra, you know, $1 an hour, when that calms down, then we'll know that we have some cause to be concerned.
Sarah Hunt, you get the final word on this, please.
I think we also have to really look at the energy situation, because if you look at what's going on with Europe right now, you're seeing some curtailment of production because of higher energy prices. And I think that that is something that is becoming a little bit more systemic than people thought. And the fact that you've had a much less demand picture in the last couple of years because of COVID has somewhat masked that. But I think that that is part of the systemic aspect of this inflation, is that your input costs are going up as well. And I think that's something that's going to be forefront into 2022 as well.
Sarah, thank you for everything. As always, Sarah Hunt and Malcolm Etheridge, and a Happy New Year to you both as well. Coming up on the program, President Biden preparing to speak to Russia's Putin amid concerns over Ukraine.
This is a big wild card for next year. I think for the time being, Vladimir Putin has to worry about a guerrilla war if he invades eastern Ukraine.
That conversation still ahead from New York. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Ever wonder how all that chocolate makes it to the supermarkets in time for Christmas? I'm James Walcock, and I got really curious how chocolate makes its way to the supermarkets every Christmas. So I came here to Nestle's distribution centre to find out how it works. Almost 120 lorries come here every day, and they drop off coffee, chocolate, Kit Kats, Toffee Crisp, you name it. If it's made by Nestle, it will come through here, and it will get sorted by machines who will then load it onto a monorail that runs right up and down the facility. Automated cranes, like this one coming in behind me now, then load all of the chocolate, storage, all of Nestle's goods into this big warehouse. It can hold up to 100,000 crates. And then after it's been sorted and stored, sometimes for months, it will then end up over here, where then lorries will then take it out to supermarkets up and down the country. You can see the entire process is done without people. Goods can come and leave, sometimes without ever touching human hands. It's one of the largest automated centres in the UK, and it opened during COVID. And this Xmas is its first big test, and so far, it looks like things are going well.
Protesters breached the Capitol.
Democracy has prevailed.
A flash mob decided to take on the short.
A giant container ship blocking the Suez Canal. 1,000 new types of crypto coins. Crackdown on tech in China. In the billionaire space race.
The Delta variant of the COVID virus.
Evergrande is the most heavily indebted developer.
Of the chip shortage.
Withdrawal of U.S. forces from Afghanistan.
We did not get everybody out.
Songs, you lie.
Rising energy prices.
In Europe, it's a huge crisis.
The Omicron variant has triggered a global rush.
summarize Russia's capacity in one word, and that is that it's a spoiler and a disruptor. The phone call today between Biden and Putin is also a way of saying, of Moscow saying, we have ways of making your lives difficult. We are a force to be reckoned with. We have real leverage in these discussions, and don't forget about us.
There is a phone call today between the President of the United States and the President of Russia, set to take place sometime between 3 and 4 p.m. Eastern Time. The talk's taking place before January NATO negotiations. I'm pleased to say that joining us now is Bloomberg's Justin Blum from D.C. Morning, Justin.
Good morning. Thanks so much for having me. The two sides are scheduled to talk at 3:30 this afternoon, and Putin asked for the call. Putin is demanding security guarantees from the West that include a halt to NATO expansion and the withdrawal of NATO forces in Europe to positions they held back in 1997. Biden's agenda is much more clear. He's going to be pushing, again, Putin to withdraw forces that are amassed on the Ukraine border.
Justin, is it encouraging that it's the Russian leader seeking dialogue here?
I'm not sure if it's encouraging. It's Putin trying to push his agenda ahead of additional talks that are planned in January. The two sides are talking, so perhaps that's encouraging. Biden says that he appreciates leader-to-leader conversations and thinks that's the most useful dialogue in this situation.
As Justin points out, that call taking place at 3:30 Eastern. Looking forward to your coverage, sir, down in Washington. Bloomberg's very own Justin Blum. A ton of economic data we need to talk about through the year, but this week particularly, just a little sprinkle. Jobless claims sub 200, 198,000. These are the kind of data points we want to see more of. Joining us to discuss, I'm pleased to say, is Yelena Shuletseva of Bloomberg Economics. Yelena, we've finally started getting down to these levels over the last couple of months. How encouraging is that for you?
I think it's very encouraging. The seasonals were expecting a small increase in jobless claims. Instead, we saw easing in jobless claims. And that tells you that companies are eager to save the existing labor force, and they're holding on to existing workers. I think it's also very important to note that I think people at the lower income spectrum will continue to have the pricing power in terms of wages. They will continue to enjoy that pricing power because there's an absolute lack of workers in those professions, in leisure and hospitality, in warehousing professions, due to less of blue-collar workers just being available. I think we will continue to see increases in wages. And in fact, if you talk about inflation versus wages, you see that the wage income is actually at the highest growth rate at 8.6% for the year as a whole since 1984. Yes, inflation is high, probably the highest since 82, but wages are rising as well.
Yelena, this is all good news, and I don't know anyone that does not want to see us get back to where we were before the pandemic. When they look at the participation rate, the employment to population ratio, where there will always be a debate and disagreement as to how you get there, what policy tools you need to use. Do you see reasons to believe it is achievable, though, Yelena, that we can get back to those pre-pandemic levels when you look at things like the employment to population ratio?
I think in terms of participation, I think we will not get there, at least not in the short run. I think it's quite a long time away from us. I think what we need to take care of is the pandemic, and that's what the Fed keeps talking about, that this is at the center of all the policy decisions, in fact. So I think until we really have it under control, and I mean like really have it under control without all these new spikes and restrictions, we will not see people going back. And the longer we wait for that, the less likely we get to pre-pandemic levels, because people adjust to the new ways. Look, we are talking like I'm working from home. Yeah. We're talking about that over the Skype. So I think that's what we face. This is the new reality. Some people just won't go back to work and will be happy to live on one income if it's a two-person household. So I think we are not going back to the pre-pandemic levels, unfortunately.
Well, the key word's happy. So long as they're happy about that, Yelena, who are we to complain? Yelena, thank you. Yelena Shuletseva of Bloomberg Economics on some of the data we've seen this morning and, of course, through much of this year. Your equity market positive a tenth with some brief sector price action. Here's Abby.
Well, John, on this morning, we have relatively muted sector action, as has been the case all week. Up top, the cyclical sectors, including energy, financials, and then comm services, your Googles and Twitters sneaking in there. On bottom, tech. Now, on the year, it's super interesting, and actually energy up 0.6%. On the year, that, of course, is the top sector, up 48%. Its best year ever, going back to when records were kept in 1990. Financials up 36%, the best year since 1997. This as yields have backed up in a huge way. That 10-year yield up 60 basis points. But tech also among the top, which is interesting only because valuation comes into concern. Let's see how it plays out in 2022.
Abby, thank you. Coming up next, your trading diary from New York. This is Bloomberg.
What's happening on Wall Street?
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Twenty-five, 26 minutes into the session, another all-time high close. On the cards, perhaps, up a little more than a tenth. The Russell outperforms up 7/10 on the Nasdaq, up a tenth on the S&P, just short of 4,800. That's the price action. Let's get to the trading diary. First of all, in the diary already, 3:30 Eastern, a call between the President of the United States, Joe Biden, and the President of Russia, too. The U.S. bond market closing early tomorrow. Remember that for the holiday weekend. Next week, ISM manufacturing, the ADP report, and the main event. Payroll's just around the corner too. Before we get there, let me say thank you. Thank you for choosing Bloomberg TV, and thank you for choosing to spend your mornings with me. I'm looking forward to being with you in 2022. From New York City, this was the countdown to the open. This is Bloomberg. Have a very happy New Year.
worker perspective. A recent headline, you got Kellogg's Cereal Union says the latest agreement that they had was rejected. Deere had to finally make a union contract. How concerned are you about the longshoreman contract and union negotiations right now?
Well, we're some time away from that. The contract expires on the 30th of June next year, and both sides have told me that they'll sit down to the table and begin negotiating in May. These are always important discussions, and usually when the spotlight is on our industry. But there'll be some issues around wages. The industry is making a lot of money. The longshore folks would like to see that. Now, I don't speak for either side, but training and development of the workforce will also be key as robotics and automation are front and center. The workers cannot be left behind.
Yeah, but to that point, I mean, do you feel like the balance, though, has shifted? I mean, for so long, workers had a lot less negotiating power. Do you feel like the pendulum's shifting?
The International Longshore and Warehouse Union, which does work across 29 West Coast ports, is very strong and a democratic organization.
Good Thursday morning. Welcome to Bloomberg Markets. In this special coverage of the week between Christmas and New Year's, we hit a 70th record close yesterday, aiming for a 71st today, and we are simulcasting this program on Bloomberg Radio and on Bloomberg Television. Paul Sweeney joins me out of New York. I'm Matt Miller here in Berlin. So, Paul, not a lot of momentum and obviously almost no volume, but we have another record high. And I always remind people, it doesn't really matter if you have no volume. For people who are long this markets, they are now wealthier than they were the day before.
They are marking to market, Matt. And again, just a little bit of a lift here in the equity markets here, but we'll take it. You know, again, low volume, but that's what you expect here on a week between Christmas and New Year's. But we are here, and we are simulcasting. We're doing it all week, and we're bringing some smart folks here, getting a look at the markets, and also taking a look ahead to 2022. So again, yeah, the S&P up about almost 0.2%. Let's see where the movers are, Matt, with Abigail Doolittle. She joins us here with some market movers. Abigail, what are you looking at?
Well, more broadly first, Paul, to your point and what you and Matt are both talking about, gains. You are wealthier today if you invested $1 yesterday, but very, very small gains, and also on that light volume, greater than 40% below the 20-day moving average. Now, interestingly, bonds, they are down just a little bit, or excuse me, higher. Yields are down just a little bit, but so fractional, it's in keeping with these tiny, tiny moves. And then crude oil up about 0.6%. So you can make the case that there's a little bit of a risk appetite here, but very, very modest.
Strategists are not optimistic for stocks in 2022. And indeed, I've spoken with a couple of portfolio managers who think we're not going to see the kind of returns that we've gotten used to over the past 3 years.
You know, Matt, it's interesting, actually, because the average forecast for the S&P 500 at the end of the year, I believe, is 5,000 or thereabouts. So that does suggest that there could be some sort of a gain. Yes, less than this year. If the high estimate on the street of 53.30, I believe, is hit, that would be a double-digit gain, so not so shabby. But perhaps what some of the strategists you've been talking to are concerned about, the inflation fears everybody is worried about, because, of course, operating margins are starting to stagnate, and companies trying to figure out how to manage these rising input costs. Will consumers pay for them? One of the best groups in this month of December, the consumer staples, because of that expectation that prices are about to rise. But will consumers continue to pay? We don't know. As for some of those movers, Biogen down after Samsung said they are not buying Biogen, which makes sense given that Samsung is an electronic company and Biogen is clearly a biotech company. Tesla, they've recalled 500,000 cards. On the upside, though, Ford is higher, as is Carnival. I don't know how many people are looking to get on a cruise right now with Omicron, but that stock is finally popping. You and Paul,
Me and
okay.
Paul we're making our reservations.
Yeah.
We're gonna
cruiser.
Where
we're gonna
to?
go on
Alaska?
on a cruise. I don't think we've decided yet, but neither one of us has been on a big time commercial cruise. Is that right, Paul?
Yeah, I have not.
And so,
but I would do it, but maybe not right now.
Yeah, no, I mean, we're going to make reservations, but
yes,
maybe for 2024. All right, Abigail Doolittle, thanks very much for catching us up on those markets. Let's bring in David Jones right now, B of A Global Research Senior Investment Strategist, and get his take on 2022 expectations as we near the end of this year with 26% gains right now on the S&P 500. What are you looking for in the coming year?
Yeah, I guess I have to say I'm one of those more bearish strategists at the moment. We certainly think that returns in the next year are probably going to be low single digits, perhaps even negative. And at the broadest level, our view is informed by the idea that rates are going up, liquidity is going down, and profit growth is slowing. And that's just a very hard environment for equities to perform at the levels we've seen over the last few years, particularly when you start at the valuations that we're starting at now.
Yeah, that's kind of where I wanted to go, David, to get your sense of valuation. There's a couple camps out there. One is, boy, this equity market's richly valued. But then another camp will come in and say, yeah, but look where interest rates are. The 10-year just still at 1.5%. So put it in that context, maybe the valuations aren't so high. How do you think about it?
Well, that's really the key, isn't it? It's where interest rates are. This market has really been a product of Fed stimulus and Fed policy. And as long as that can continue, then you can see the market continue to perform the way it has. But the thing is, it's not going to continue. The Fed has already signaled that it's going to tighten, remove accommodation. Certainly, it's sped up the pace of the taper. And the Fed itself, through its SEP dot, says it's going to hike perhaps 3 times in the next year. We actually think the Fed is probably going to have to do a little more than that. So interest rates are certainly on the way up, and that's probably going to affect some of the asset allocation going forward.
So you think the Fed will hike 4 times in 2022?
Yeah, potentially even more than that. You're really in a situation at the moment where the Fed is certainly hiking. The question is whether it's hiking into an acceleration or whether it's hiking into a deceleration. At the moment, the economic data look good, and our economists think that growth is going to be still fairly robust. So if you're hiking into an acceleration, you're probably going to have to do even more tightening than the market has currently priced in. So what we think that leads to is that you're going to have a rate shock in the first half of next year, and you're probably going to have a little bit of a growth scare in the second half. As the curve starts to flatten very sharply or perhaps even invert.
All right, so if we have a rate shock, a growth shock, what are you advising your clients to do with their, if they're allocating capital to the markets next year, where should they go?
Well, we think, the smart bet is to look at some of the quality defensives, so staples and utilities globally, perhaps even more outside the U.S. than inside the U.S. Our view is that, look, if central banks can thread the needle and bring down inflation by raising rates, but not hurt growth substantially, well, then perhaps in that scenario, the optimal allocation would be some sort of barbell where you have equities that do well in inflation, such as energy, such as materials, and then barbell that with quality defensives like staples and utilities. Or if you get something that we think may occur or has a higher likelihood of occurring than the market has priced, and that is a growth slowdown or recession scare in the second half, you're still going to want to have quality defensives. So either way, quality defensives are a good bet, either as a hedge or as an outright long.
But not bonds, right? I mean, if you expect 3, 4, 5 rate rises in 2022, you don't want to hold you don't want to hold treasuries.
That's certainly not at the short end. But if you start to see an inversion of the curve and a flattening of the curve, in that scenario, you certainly want to be long dollar and perhaps even longer bonds. But we think that's probably not the not our consensus benchmark view.
So, David, again, you just mentioned the dollar. I mean, I'm searching for a bear case for the U.S. dollar, but speaking to people like you who think about this rising interest rate environment and how it may even be more aggressive than the Fed is signaling, it's tough to come up with a bear case for the dollar, isn't it?
It really is. I mean, you can, of course, always come up with conceptually a scenario in which the dollar would weaken. Perhaps if Omicron were to turn out to be worse, or God forbid, there were even something more aggressive and more lethal down the road, well, then you could then have a scenario where the Fed actually perhaps pauses or resumes some of its emergency liquidity facilities in the event of a resumption of a lockdown. In that case, of course, you could see the dollar start to weaken, or if the cases are more severe in the U.S. than the rest of the world.
David, what do you think happens to the Fed balance sheet? I mean, if they're raising rates by so much, are they winding that down?
Probably not now. They're probably going to reinvest, maturing issues. They had the experience a few years ago where they were unsure how far to bring down the balance sheet, and they basically had to run into the point where the curve steepens, and then they had the issues in the repo market. So now they have a better sense of how far they can conceptually bring down the balance sheet, but they're several $1 billion above that. So. I don't think they reduce the balance sheet quite yet, but even if they do, they have plenty of room to do so.
All right. David, thank you so much for joining us. Really appreciate getting your thoughts. David Jones, he's B of A Global Research Chief Strategist. A little bit bearish call out there. Interesting to get. We'll have more coming up.
Protesters breached the Capitol.
Democracy has prevailed. A flash mob decided to take on the shore.
A giant container ship blocking the Suez Canal.
1,000 new types of crypto coins.
Crackdown on tech in China. And the billionaire space race.
The Delta variant of the COVID virus.
Evergrande is the most heavily indebted developer.
Of the chip shortage.
Withdrawal of U.S. forces from Afghanistan.
We did not get everybody out.
Songs you love.
Rising energy prices.
In Europe, it's a huge crisis.
The Omicron variant has triggered a global rush.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
For 12 and a half years, you held what was arguably the most powerful job on Wall Street. What's it like now, being the former CEO of Goldman Sachs?
Bit of a relief. I'm not sure it was the most powerful. I spent a lot of time arguing against that, and I always thought to myself, gee, if I'm so powerful, how come I'm taking so much abuse?
How are you keeping busy?
Well, here we are chatting. Somehow, I'm not scheduled. I don't set my clock most mornings. And somehow I get to the end of the day, and I've been busy the whole day. I spend a lot of time reading. I try to learn stuff. You know, originally I thought, and I wouldn't preclude going back and doing something else more intense certainly than the life I'm leaving now. I originally thought and was advised to take a gap year, and then when I finished my gap year, the country decided to go on its own gap year. 1 year plus gap year. So those consecutive gap years leave me in this place. And I'd say the longer, the longer you're not setting your clock in the morning, the less you want to set the clock in the morning. But after 40 years of running around the world and living in the macro markets and knowing the price of everything all the time, and knowing that anything that could go wrong anywhere in the world would affect us and have a huge consequence for us, it's a little bit hard to drop it. And there are parts of it that I never thought I'd miss, but I do miss.
What are those things? What do you miss?
Well, I miss even sometimes, even as I say, I feel a little bit of relief in not having someone being intense, but I miss that. I miss the background noise, even of having things to fret about all the time.
Is there such a thing as a substitute for that?
Well, I'm sure there's a lot of people who work at great organizations and have quite fulfilled lives and give their all, and they're not at Goldman Sachs. So there's a lot of other things that one could do. If you're asking me, have I found a passion away from the commercial? I'm a commercial person, and so I'm involved in some philanthropy stuff, and I've elevated my involvement in some things in this period. And I enjoy that, and you could be quite commercial in those places too. You can be a commercial person in government in the sense of getting things done and taking risk and pushing things along, and you could be that way in a philanthropy. But I'm a P&L guy, and I kind of like that stuff, and I like the immediacy of it, and I like the intensity of it.
Your four predecessors as chairman of the firm, Hank Paulson, John Corzine, Steve Friedman, Bob Rubin, all went on to serve in government.
Don't leave out John Whitehead.
Well, there was one in between, right? John Weinberg.
It was the same time as, yes.
Why not you?
Well, I would say among the many reasons, I haven't been asked. So that would have to stay. That would be one of the prominent reasons. It's a little bit of a charged environment. I wouldn't say when you look at the administration, you're finding a lot of people from finance and business backgrounds, even in traditional roles in which, that were occupied by financial people or commercial people or business people. So I would say that it's not something that I mourn, but certainly I would have gone into, I would have considered public service because, what else is left? I worked at a high level at Goldman Sachs for 37 years. You want to do something different and make a contribution. So something that, might have, but I'm not mourning it. I understand why it's not, why it's not happening now.
I hear Janet Yellen is looking for an exit. What about Lloyd Blankfein for Treasury Secretary? Would you throw your hat into the ring if you thought they were interested?
Who offered that job would decline that. I mean, that's you'd have to be preparing for your end of life or jumping off a cliff or something like that. Of course, that would be to make that kind of a contribution or to be at that fulcrum of that very large lever. Of course, you'd want to do it. But again, I have no real connection to that. I mean, we can go through this, but I don't think that that's going to happen.
Extra $1 trillion in spending not increase inflation?
By increasing the productive capacity of this country. And that's a very important thing that we frankly have not successfully done across most of my lifetime. You know, I've been waiting for this legislation for months since I became Transportation Secretary, but various presidents have been hoping to reach this day for decades, and it hasn't happened for all kinds of reasons. The American public has been rightly impatient. Now we're getting it done, both making up for lost time and laying a better foundation for the future. Let me also point out to the fact that Part 2 of the President's agenda, what I like to call the big deal. But Part 2 of that, the Build Back Better Act, has even more that will help beat back inflation by lowering some of the costs that Americans feel most acutely, the cost of childcare, the cost of healthcare, the cost of housing, the cost of prescription drugs, bringing those down while also making sure that we ease some of those labor market issues we have by making it easier for working parents to afford to go back to work.
Protesters breached the Capitol.
Container ship blocking the Suez Canal. Types of crypto coins. Crackdown on tech in China. In the billionaire space race.
Delta variant.
Chip shortage.
And rising energy
It's a
prices.
huge crisis.
The Omicron variant has
Happy holidays from your Bloomberg family.